and IFS, most of the questions you will find in the actual examination, they are from module D. And the reason is very much clear. We have 17 units in the module D itself. That is the primary reason why maximum questions are asked from this particular module. But whether you should only focus on module D, no, that is not the right strategy. For that, we have a dedicated session, the right strategy session on YouTube as well. So after the session is over, do watch that particular class so as to have the clarity that how you should approach the IFS subject in the remaining time duration. Now let's switch to the unit number 29. This is the first unit of module D, known as financial markets, and overall it is just an overview. Right? Overview of the financial markets we will be looking into in this particular unit. And what type of questions are asked, that you must know. Mostly they ask the questions based on definition. Fine, all those definitions which are given in this particular chapter, they are automatically important, and the questions more or less are around them only. And one important aspect of unit number 29 is that it will create a linkage. If you understand all the types of financial markets in this particular lecture, or for that matter in this particular unit, you will find the learning very easy. When your learning, the journey of your learning will become very much easy for the upcoming units, because these particular topics will further extend into various units. Fine, these are just topics, subtopics of this unit. But going further, unit number 31, 32, 33, you will find direct reference in a particular unit about all these subtopics. That is why we say that do not ignore unit number 29th. So let's start our discussion with a question that what is a financial market? So simply stated, financial market is just a system. A particular process flow has been maintained, has been initiated, where the money is involved. And why the money is involved? Because ultimately the trade will happen. And why we are trading? In order to have the profit. Now one would say that profitability is just one aspect. Whether we are out for the profitability only, we are looking only for profitability or not, answer is no. We want good capital investment, because we want to develop a nation also via the financial markets. The purpose I'm telling you. When we talk about the corporates, they have different mindset. They want profit plus sustainability via the financial markets. For individuals, again, profitability will be the reason. So the reasons may vary for the various players who are involved in the financial markets, but ultimate goal will be to trade, to borrow or lend. Some people, some entity will borrow from the financial market. Some people, some entity will lend via these financial markets. Some will invest in these financial markets, and some will try to protect themselves from the risks involved in the market. Fine. So simply stated, financial markets, it has varied, you can say, portfolio, or for that matter, varied reasons why people trade in these markets. And this system where the money is borrowed, lent, invested, and protected is known as your financial market. What else we have to know initially only? So it connects people, and ultimately the funda which is involved in the financial markets, it is the interconnectedness of various entities involved. So it connects all those players involved in a particular financial market. So it connects people who have money with people, or the businesses who need money. So an individual might need some amount of money, so they can approach the financial market, or for that matter credit market directly. Then there will be certain institutions, certain corporates who need money for their own good, for making good amount of profit in the future. They will approach some another institutionalized framework or float certain shares in the market. Right? So overall, when we talk about financial markets, the reason to initiate their particular process in the financial market might differ, but all those players have a particular motive via which they will be approaching this market. And that is the reason why we have different types, or for that matter sub markets in this financial market, under the ambit of financial market only. What are those? Starting off with credit market, the simple loans we call them. Then we have money market. The money market, it involves short term, you can say, instruments. Then debt market. When we say debt market, the prime example will be your corporate bonds, or for that matter government securities. Then forex market, the foreign exchange market, more or less the trading, the forex operations. You are sitting in India, but your transactions are going abroad, and various transactions are there. Export transaction is there, remittance is ongoing. It will be covered under which type of financial market? Foreign exchange market. Then we have derivatives market. In order to manage your risk, fine, risk management is the ultimate goal in the derivatives market. The underlying asset is there. You are not taking any kind of risk. You want to take minimum risk. You have the support from the derivatives market. Then we have capital market, long term investment. In long term transactions you want to have, whether it is in the form of lending. For one entity it will be the amount which has been lent, the another entity will be receiving that amount, but for long term. Then we have insurance market. Fine, in insurance what we do, we say that we want to protect ourselves from the risks which are involved. Two different things. One is risk management. There will be risk in the markets, but derivative market will try to manage that risk. Then we have insurance market. We know that there will be risk. Fine, the risk will be there, but we don't want to get involved in that type of risk, not at all. So we want to protect ourselves from that particular risk. That is insurance market, a very thin line of difference, but yes, you must acknowledge this particular difference. Lastly, we will be having the mutual fund market. What is mutual fund market? Everybody knows the mutual funds are being traded. Fine, you are having hefty returns on the mutual funds. That is the mutual fund market. This is just an overview. We'll be looking into each and every market now in a bit detail. Starting off with your credit market. So what is the purpose of credit market? Simply to provide loan and credit. Very, very simple. Purpose of money market, for the short term liquidity, to ensure short term liquidity. Debt market, for the long term fixed income. Fine, you want to have the long term fixed income, you can trade in the debt market. But when we say that long term capital formation, a particular country wants, or for that matter there are various entities involved which want to have a long term capital formation, for that you have capital market. And these keywords which are listed in the purpose row, you will have to remember. Why? Because ultimately definition based questions you can solve from these keywords. That is why I have made this particular table of difference. Fine. What is the purpose of forex market? If somebody asks, currency exchange. Fine. Nobody will say na, that you have rupees, the rupee note, 500 rupee note, just give it to one particular trader who is sitting in USA. Right? You have to exchange that particular currency. Then we have derivatives market, risk hedging. Underlying asset is there. You don't want to have the maximum risk, because everybody knows in financial market the risk is huge. Fine. The risk appetite of derivatives market is also high. But why we are trading? In order to manage our risk. Capital market, again capital formation will be there. Insurance market, risk protection. Fine, risk management is there in the derivatives market. But when we talk about insurance market, it is risk protection, complete protection. We don't want any risk. That is why here it is written low risk. Mutual fund market, again investment pooling. Various investors are pooling their money, and ultimately the profit is being circulated. Fine. So the purpose is very important. You should be having no doubt about any of these purposes. Next comes the time period. See, the time period, there are three domains, or for that matter, three classifications under which we classify the time period. One being the short term, then medium term, and the long term. Out of all these, only one particular market is there where you cannot say for sure that whether the time period will be short, long, or medium. Why? Because it depends on the contract, and that market is derivatives market. In derivatives market, it only depends on the contract. Fine. So very, very important point which you should know, that in derivatives market, nobody can tell yes that for sure the derivatives market will trade in the long term only, or for that matter short term only. No, it totally depends upon the contract. And in what else we have to learn, understand the types of various derivative market, we'll be looking into the further chapters also. For now, for today's session, just go through this particular table. So the time period for credit market, short to long term. In the credit market, you have banks involved, NBFCs involved, and they are doing what? Short-term lending. Long-term lending, more or less, you will find the financial institutions here. Then we have money market. In money market, the time period is again up to 1 year, because they are for the short term. Fine. Short term liquidity is being ensured via the money market. Like when we say na, that the RBI is providing money to the banks, what is RBI doing there? RBI is trying to maintain the liquidity in the economy via the banks. Fine. So money market, you will find the time period up to 1 year, and the key participants will be RBI, banks, or the financial institutions. When we say debt market is again medium to long term, the time period will be. And in the debt market, who are the key participants? They will be the corporates, the government. Fine. Government is the key participant via the government securities, but corporates also participate via corporate bonds, long term corporate bonds. Forex markets, more or less short and long term time period. You can see that very minimum market operations in the forex market is there, where you will be utilizing the medium term, or for that matter mid term transactions. Mostly they will be either the short term transactions, or for that matter long term operations. Derivatives market, it totally depends on the contract. Capital market, long term. Always remember, capital market is for the capital formation, and in a particular economy, or for that matter in a particular company, or for that matter any corporate entity also, you won't be able to form the capital if you are just going around for short term or long term, or short term or medium term. You have to have the time period as a long term investment. Insurance market, mostly you will find long term only, fine, beyond 10 years. Mutual fund market, medium to long term. So the time period is also important. Not only the purpose, but the time period as well. At least you must have an idea, right? Then who are the key participants in all these markets? Banks and BSCs for the credit market, RBI, banks, the financial institutions for the money market. Debt market, government and the corporates. Forex market, you will have RBI, banks, as well as exporters. Fine, because ultimately the exporters of our country, they require the currency exchange, so they will be participating via the banks. RBI will be regulating it. Derivatives market, traders, the investors will be involved here, and the same investors will be in the capital market also, as well as your mutual fund market. Insurance market, you will find the policy holders for sure, along with the insurers, the companies, fine, who are providing the insurance to the customers. Then we have the instruments. What are the types of instruments? In the insurance market, if I ask you, what will be the type of instrument? You won't be giving FD in the insurance market, na? You will be providing what? Insurance policies. For mutual fund market, the mutual fund units will be given. Capital market, shares will be there. Derivatives market, mostly you will find F&O, right? Futures and options. What is futures and options? We'll be looking into the further chapters about the F&O. But right now you can say that for the speculative trading, we utilize the F&O operations via the derivatives market. And this was mentioned by the finance minister also this time. The reason why we have increased the STT, securities transaction tax, because of speculating trading only, speculative trading in the derivatives market. Forex market, what will be the instrument? The exchange, USD to INR, Euro to INR, all these. Debt market, as we were discussing, long term fixed income. Who is the major player here in our country? Government via government securities, and the corporates are also there via corporate bonds. Money market, we have studied in the monetary policy chapter also. Treasury bill is there. Then we have the commercial papers. Commercial bills are also there. What is the difference between commercial paper and commercial bill? We'll be looking into that also in a few minutes. But right now, just remember that treasury bill, CP, the call money, all these are money market operations. Lastly, credit market loans or the credit cards. Credit cards are also under the credit market only. So I hope that till now there is no doubt, right? When you talk about the financial market, you must be very much clear that which market is doing what. Otherwise, what will happen after one or two chapters, unit number 30, 31, 32, you will find that something is missing. We are not able to comprehend with whatever is being discussed. Right? These basic terms you must understand first, only then go to the further chapters. Now comes the risk level. So the risk will depend upon the instruments only. So when we talk about credit market, it has medium risk. Money market is low risk. Fine. Short-term liquidity, no risk at all. The least risky market, as we call it, will be the market where the government securities are being traded. So for the government securities, we say that low risk is there. Why? Because it is being floated by the government. But in the debt market, we have another instrument also, the corporate bonds, because of which the risk can be of medium level. Forex market, high level risk is there. No doubt about that. Derivatives, again, they are already, their inherent nature is that they are highly risky. That is the reason why we are providing the risk management in the derivatives market. So risk level is always high. Capital market is also high risk. When you talk about the insurance market, it is low risk. No risk is involved, in fact. Mutual fund market, it is of medium risk. When it market can go up, can go down. Everybody knows that. What are the examples now? Credit market, everybody knows that it will be the type of loan, home loan, MSME loans. These are credit market instruments, or for that matter, the examples. Money market, you have the repo, treasury bills. Debt market, the RBI gilt, fine, regulated by the CCIL, the government securities when we talk about. Then we have PSU bonds also here. Forex market, export payments, that is the prime example. For derivatives market, Nifty options. Then capital market, you have the NSE, BSC, the Sensex, the initial public offer IPOs will be there. Insurance market, LIC, we have the health insurance also. Then mutual fund market, we have various types of funds. Index funds are also there. SIPs, the most common one. So these are the examples which we will be learning in detail in the respective chapters, because mutual fund has a different chapter, separate chapter in module D we have for the insurance market. For derivatives, separate chapter is there. For forex also, like that. Who is the regulator? Now comes the question about the regulators. So RBI will be regulating your credit market, your money market, forex also. And when we talk about the debt market, some operations will be directly regulated by the RBI, some will be regulated by SEBI. Fine. So both, you can say, are the regulators in your debt market. But specifically, SEBI regulates your derivatives market, capital market, and your mutual fund market. And insurance market is regulated by our insurance regulator, that is IRDAI. Right. So mind it when I say this, that this particular table is the most important one when it comes to unit number 29. If you have already studied unit number 29, well and good. But if not, then I would recommend to take a screenshot of the same. Now let's have elaborate discussion about each of them. Starting off with capital market. What do we mean by capital market? Simply stated, we are providing funds, right? We are providing funding via credit. So banks will be providing that. Along with that, you will be finding some non-banking financial institutions also being the players of credit market. Plus, there will be some unorganized sources also who will be providing credit. Unorganized sources, the private money lenders, right? So the major institutional purveyors of credit in India are banks and your non-banking financial institutions. Banks can be commercial banks, cooperative, or the differentiated banks. Non-banking financial institutions, NBFCs, right? What do we mean by purveyors? A very important word for the financial markets. It is just a synonym of sellers. Fine, sellers, or for that matter, a particular entity which is offering something, right? Offering you with the credit. So banks are the institutional purveyors in our country under the credit market. So they are providing you with this facility of credit. So these words also you should remember, purveyors. They can ask you in the question in the actual exam. And if we do not know the exact meaning of such terms, we will get confused, right? So the major institutional purveyors, banks and non-banking financial institutions. But what about non-institutional or the unorganized sources? It will be the private money lenders. Now comes the question that what is the most important aspect of your credit market? It is to define that which particular type of loan, or for that matter type of advances, type of credit you want according to your need. So the important aspect of credit market is its term structure. Fine, whether it is short term, medium term, or long term credit. Mostly you will find that short term credit is being provided by your banks and NBFCs. And when we talk about the long term credit, it will be provided by the financial institutions. Right? The financial institutions, they will be providing long term funding as well as the medium term credit as well. So a very important point to note. Normally we think that banks also provide long term funding, or for that matter long term credit, but in the credit market you won't find much of the bank's participation when it comes to the long term lending. That is why we say medium term and long term credit needs will be fulfilled by the financial institutions. Fine. So this was for the credit market. Now let's move on to the money market, a much more you can say relevant, or for that matter important for our examination. So money market, simply, it is a type of market which ensures liquidity. Fine, liquidity is the keyword here. Ensuring liquidity, or for that matter, regulating this liquidity is the important aspect or the function of your money market. So money markets, they perform crucial role of providing a conduit, a pipeline. Fine, conduit is what? Just a pipeline for equilibrating the short-term demand for and supply of funds. So equating the supply with the demand of funds. The funds has there is a particular demand of funds and there is a particular supply of the funds. What has to be done for ensuring this supply? What has to be done for the demand? All these things will be regulated via the money market because of the inherent nature that it acts as a pipeline of supply and demand, thereby facilitating the conduct of monetary policy. In monetary policy, you must have seen that RBI is doing what? It is just trying to manage the inflation, but ultimately how it is managing via the monetary policy tools, and how the monetary policy tools are working via the regulations, or for that matter regulated operations of money market. While interbank money markets and the central bank lending via the repo operations or discounting, they provide liquidity for the banks. These repo operations, though, we know because we are bankers, we know that yes, liquidity for the banks will be ensured by the RBI via various measures. But private non-bank money market instruments like commercial papers, they provide the liquidity to corporate sector. Fine. So when we talk about the central bank lending via the repo operation, the banks will be having some liquidity. Fine. But when we say that there are certain phenomena via which we ensure the liquidity in the corporate sector, not in the banking sector, in the corporate sector, how you can do that? Via the non-bank money market instrument, primarily through the commercial paper. What is the commercial paper? We will be looking in the next slide. So the money market instruments, you can say call money is there, certificate of deposit, treasury bill, other short-term government securities are there. Then we have the example being repos only. The banks acceptance, commercial bills, very important, commercial paper, intercorporate funds, all these we will be looking now. So money market has the most prominent instruments These seven are the most prominent ones. And when we say the meaning, along with that, who will be issuing these particular instruments, that becomes very, very important for our examination. Commercial papers, the CD, certificate of deposits, we'll be looking into a separate chapter also. Right? Once we are done with the basics, then we will be moving to further chapters where the discussion, elaborate discussion will be there for the CP as well as your CD. But right now, you should focus on these 5 pointers, which will differentiate between various instruments. So when you talk about the call money, what is the meaning? Simply stated, you need overnight funding. So overnight bank borrowing is being ensured via the call money operation, or for that matter, instrument. Certificate of deposit, they are for short term bank deposit, right? They are basically the short term bank deposit only. And when we talk about short term bank deposit, it is not like the call money is for overnight, one day, within one day, or for that matter within a time period of 24 hours, the operation will commence and it will be initiated and it will be done away with. But CD, your certificate of deposit, is having a specific tenure. 7 days, starts with 7 days till 1 year it can go. Treasury bill, again, it is for the government short term borrowing. And when we talk about how the treasury bills operate via various tenures, 91 days, 182 days being the normal ones. Then repo operations, again, we talk about the borrowing. So the collateralized borrowing will be done via these repo operations. You have to have some collateral against which the lending will be done. Commercial papers and commercial bills, a very important point of difference between them is commercial bills are for trade only, and trade related bills we settle via the commercial bills. Commercial paper, there will be corporate borrowing. Fine, the corporates are involved, large corporates are involved here. So corporate short term borrowing, commercial paper, commercial bills for the trade related bills. This difference you must remember. Normally students feel that commercial bills is just the umbrella statement, and ultimately the commercial papers are just a part of commercial bill. It is not like that. Commercial bills specifically for the trade finance, for working capital of the, you can say, long term, for the short term, and your large corporates is your commercial paper. Then we have intercorporate funds. So the short term loan between companies, various companies are there. So short term loans being revolved around the particular companies, fine, various companies, short term loan only for the corporates, fine. The issuer will be the corporate. Intercorporate funds, ICF, more or less, it is a confusing one. And when we talk about right now, what should be your approach? Simply just try to, have one important example in your mind, that whenever the corporates require money for the cash management, fine, whenever they require funds for managing the cash, then ICF will be there. Otherwise, commercial paper will be there. Simple. Okay. So commercial paper, intercorporate funds, both of them will be issued by the corporates only, large corporates, or for that matter, corporates in case of ICF. And the commercial bills, since trade related bills are there, so the issuer will be the businesses. When we talk about the issuer of other four, banks will be the issuer of call money, certificate of deposit, issuer is banks again. And when we talk about government of India, will be the issuer of T bill, the treasury bill, but not directly via RBI. It will be commencing the operation. Repo, again, banks or your RBI will be involved. So the issuer is also very important. Corporates, for large corporates, or for that matter corporates as whole, we have commercial paper and ICF. Two options are there. For businesses, more or less commercial bills is the only option. Now comes the tenure. Tenure we have just seen: overnight borrowing, call money, one day overnight; 7 days to 1 year, certificate of deposit; 91 days, 182 days, you have the treasury bills; repo operations, overnight to few days, fine, it is not a long duration; commercial bills up to 180 days, that is the limit which has been decided in trade finance; commercial papers up to 1 year; is the tenure, and intercorporate funds, again, short term will be there. Short term, you will find that the risk levels are medium, at least higher than the commercial papers, but more or less both of them have the tenure as short term itself up to 1 year. Next, the risk level. Let's just quickly see them also. So risk level for the call money is very low, very low. Nothing to be worried about because it's just a overnight operation. Certificate of deposit, again, low is there. For T-bill, it is nil, no risk whatsoever, because who is the issuer? Government of India, no risk is involved. Repo operation, very low. Again, low, you can say risk is involved in the commercial bills also. Low to medium in commercial paper, and intercorporate funds has the medium risk. Out of all these, if you have to pinpoint that which of the following has the highest risk, then it will be ICF, because for the cash management, you are going through this particular instrument. Right? So medium risk is there. But overall, when we say na, in money market, the risk level is overall very, very limited. It is not that high as compared to the derivatives. So the purpose for call money will be to meet the daily liquidity, daily basis liquidity. Short term funding you want, then certificate of deposit is a best option in the money market. For government financing, you have the T-bills. Liquidity management under the money market, how you will be able to do that? We have seen it in module B also. So repo operations will be there. Commercial bills for trade financing, simple. For trade financing, we have only one option in the money market, that is your commercial bill. For working capital of your large corporates, you can go with the commercial papers. And intercorporate funds, directly the purpose lies in the cash management, which makes it a bit risky as compared to the other instruments of money market. Right? So again, these tables are very important, like this one in the money market and this the overall financial market. Now let's move on to the next type, that is debt market. What is debt market? So simply stated, you are trying to have some funding, or for that matter some investment whatsoever the purpose is, via the government securities. So mostly you will find government securities being traded in the debt market. So the debt market largely comprises of government securities and to a smaller extent your corporate bonds. So corporate bonds will be traded by the corporates, fine, big corporates you can say. So the government securities, what do we mean by that? The definition is very, very important. Whenever we say that financial markets chapter is tricky, it is not that tricky if you know the verbatim definition. Government securities, everybody knows that yes, government will be floating some securities via RBI, and the people will be buying them, or for that matter selling them according to the need, according to the liquidity which is prevailing in the economy. But what is the definition of government security? So government security is a tradable instrument issued by the central government or the state government. Simple. Just a term has been added, that is tradable instrument. You can use it in either form. Long-term securities are also issued by the state government, right? So when we talk about government securities, normally you will find that the state governments do not indulge in the direct security dealing, because the central government is doing it via RBI, and the state governments, they have a separate term altogether for their long-term securities, whatever they are floating, known as state development loans, the SDLs. In your RBI chapter only, the monetary policy chapter, you must have read that there is a particular term utilized for the lending which RBI is doing to the state government. Fine. What is the name of that particular term? Do let me know in the comment section. Fine. Next, we have the companies who raise the funds for a longer period, let's suppose 5 to 10 years, through the issue of typical long-term debt instruments. That particular instrument is your corporate bond. So the companies, they want to raise funds not for short term, but for longer duration, let's suppose 5 to 10 years. How they can do it? Via these corporate bonds. And these corporate bonds are part of your debt market only. Fine. Next is Forex, the foreign exchange market. What is the name of that particular process? Ways and dash. Do let me know in the comment section. Fine. Okay. You have studied it in the FRBM Act, I think. Okay. Next, let's move on to the forex market, the foreign exchange market, where you will find a good amount of questions based on the future chapters. Fine. There are various chapters which are directly related to your forex market. So from those chapters, good number of questions are regularly asked by the IIBF. So what is forex market, or for that matter, who all are involved, who are the players in this particular market? Forex market for your exchange, fine, the currency exchange is happening, but who is doing it, or for that matter, who are the players here? We have the banks known as authorized dealers, we have the customers, mostly the exporters you can say, and your regulator, that is RBI. So when we say that forex market, it seems liberal to us, right? You can exchange the money freely now. But whether it was the norm starting from 1950 only, no. Till 1977, this was not the normal thing. Regulation were too high, and the forex market was not open for all. But in the year 1978, the banks were permitted by the RBI to take trading positions. So foreign exchange trading started off in 1978, but still there was some inhibition regarding the trading which is happening in the foreign exchange market. So the push was provided in the liberalization era. The economic reforms, or for that matter, LPG reforms, liberalization, privatization, globalization of 1991, whereby India became practically convertible on current account. What is the meaning of this term? Very important term. When we say that you can directly exchange the currency of your nation with the listed currencies abroad, that is simply the meaning of convertibility. Fine, the convertibility of currency can happen. Now it will be it will be at your prerogative whether you want to exchange the currency for the day-to-day transaction, daily basis transaction, or for that matter, long-term transaction. For that we have two terms: day-to-day transaction, the current account will be involved, and for long-term transaction, capital account is involved. Fine. So convertibility on current account, now it is freely there. Partial convertibility is there in the capital account right now in the India. So people and businesses in India can freely buy, sell the foreign currency for normal trade and services transaction. That is the norm right now in our nation. But it was not the same in your 1980s, or for that matter 1978 also, it was not there. So when we talk about the expanse, the turnover, since we are saying that we have improved from a particular mark of 1978, whether the same is being replicated by the volume of forex market, the answer is yes. It has led to increase in the turnover in our forex market, and it has ultimately risen to US $60 billion daily. Fine, that is the number. Earlier it was in 2000, the number was only 6 billion US dollar. Now it has increased to 60 billion US dollar, which is a jump of 10x, a quantum leap we can say, for the forex market operations in our country. Fine. So I hope that you will revise all these aspects which we have studied today. Fine. The meaning of current account, meaning of capital account, the derivatives market, other types of financial markets, everything we will be covering in our paid sessions. For now, today, what you should do, try to answer this question. We have covered the institutional purveyors, fine, the credit market. For your reference, let me just tell you, try to answer the question based on that. Any kind of doubt you have right now, just feel free to ask me. Okay, try to solve this question. See, solving question is very important. Our sessions will make much more sense if you start solving questions. Okay. So the question is, which of the following statements is are correct regarding the major institutional purveyors of credit in India? So what do we mean by this term institutional purveyors? We have just seen in this particular session, institutional purveyors are what? They are just the operators, fine, primarily the sellers or providers of your credit in India. So the statements, we have four statements here. Major institutional purveyors of credit in India are banks, yes, the commercial banks, cooperative banks, differentiated banks, all these types of banks are there providing the credit, and your non-banking financial institutions, that is NBFCs. True. The first statement is correct. Then we have non-institutional or unorganized sources of credit include money lenders, indigenous bankers, sellers for trade credit. Again, this is right. We have seen that unorganized sources primarily include your private money lenders. Then important aspect of the credit market structure is the terms. We have short-term credit, long-term credit. Also the medium-term credit is there. So third is also right. Lastly, we have the banks and NBFCs predominantly cater to the short-term needs. This is true. Banks and NBFCs for the short term. And what about the medium and long term? We have the financial institutions. So all the four will be the right answer. Correct answer will be option C. Yes, C is the right answer here. Okay. Any doubt in this? Fine. Next question. Now let's try to solve one-liner question, one single line question, as we call it, or for that matter, 0.5 marker question, which we will see in the examination. So in this particular session, you will find question uh, one, which was of 2 marks, you can say. This is 0.5 marker. Next question will be of 1 mark. What are the long-term securities issued specifically by the state governments called? So definition-based question, special terms based questions you can expect in the examination. So just now we have seen that long-term securities issued by the state governments, they are known as state development loans or the SDLs. C is the right answer here, right? Then next question, which statement regarding corporate bonds is true? So if you have understood the difference between government securities and the corporate bonds, then you can easily answer this particular question. So corporate bonds are issued by central government. No, that is not correct. They are short-term instruments, usually maturing in less than 1 year. Again, long-term instruments. The corporate bonds are for what, 5 to 10 years. They are instruments used by companies to raise funds for longer period. Yes, such as 5 to 10 years. Again, this is the right answer. Option C will be the correct answer here. Something involving the money will be there. We have seen the classification in the previous lecture of financial markets. Various markets are there. When you talk about the credit market, money market, debt, forex, derivatives, capital, insurance, as well as mutual funds market. But what do we mean by these markets specifically, be it the credit market or for that matter money market? We'll be covering them in the upcoming chapters. This chapter is dedicated to money market, unit number 30th. Now, as I was telling you that some monetary operation will be ongoing in the money market, one of the type of financial market where money is involved. And with the name or the word that is money is associated with your central bank. So RBI is directly involved in the money markets. And via the RBI, you will be having n number of stipulations and number of regulations which will ultimately regulate the money market. What is the definition of money market then? Simply stated, all the monetary operations conducted by central bank in the pursuit of monetary policy objectives form the money market. So RBI is sitting at the helm of regulating the monetary policy of our nation, and how RBI ensures that the monetary policy objectives are being met in Indian financial market. That particular platform is provided by the money markets. It is a market for short-term funds, a very important pointer which we have highlighted in the last class also, that short-term funding is the mode of operation via which the money markets function. with maturity ranging from overnight within 1 day, or for that matter less than 1 day sometimes, to 1 year, and includes financial instruments that are deemed to be close substitutes to money. Fine, direct money is involved, yes it is involved, but some equivalent, or for that matter some substitutes to the money are also involved. So how you should interpret money market as such? First thing, that it is a regulated market, regulated by the RBI. Second important point, that the short term funds are involved here from overnight to 1 year. Within 1 year, the operations will be done. Also, a very important pointer in the money markets is that money is involved. Fine, money or its substitutes, they are involved. And when we talk about the functions of your money market, what are the basic functions? So primarily there are three broad functions which the money markets perform. First one being, it provides an mechanism, equilibrating mechanism for demand and supply of short-term funds. So all of you know that when we talk about the financial market, there is a process flow which is going on from the entity having surplus of fund. They will be supplying the funds to the entities who are having deficit of funding. Fine, deficit funding is there. So this is how the financial market works. The surplus funds flow towards the deficit entity, and this particular point is directly related to the first function of money market also, that we are trying to provide short term funding for the demand which has been created in the market, and the supply for the same will be ensured using the money market. Right? So demand and supply, or for that matter surplus funds, will be supplied to those who are having deficit of funding. Then second important function, it enables borrowers and lenders of short-term funds to fulfill their borrowings and investment requirements. Fine. So when we talk about the borrowers, they are here in the markets for what? For borrowing. They want something. That is why they are sitting in the market. And the second entity will be the lender. Why they are here? They have the money. Then why they are sitting in the financial market, or specifically money market? Because they want to earn via investing their funds. Right? So both the parties are in a win-win situation. But the important pointer here will be, in the money market, that short-term funding is involved at an efficient market clearing price. Fine. So you must have seen in unit number 15th, where we talk about demand of savings and supply of savings, right? Where the demand will be there in the market and supply will be from the household income, or for that matter other business entities who will be providing the money to those who are demanding the money. And in lieu of providing the money, the particular households, or for that matter business entities, what do they want? They want some interest to be earned, some interest income should be there. And what does the uh, entity who is demanding the money wants? They want lesser rate of interest. Fine, they do not want to pay hefty rate of interest. Fine. So a perfect balance need to be there between the rate of interest which the suppliers want to have, and the rate of interest which the people who are demanding are having. Right? So this particular balance will be provided by which mechanism? Demand and supply. In unit number 13th, we have seen in the introduction of microeconomics that a particular price, a particular rate where the people demanding the money, or for that matter demanding any product, they are ready to pay a price, and those who are supplying that product, they are also okay with this price which has been quoted in the market. The people who are demanding the product, they are happy to pay this much price to the suppliers, and suppliers are also happy to receive this price. Why the demand guys are happy? Because they need not to shell more money. Fine, they are much more happy with this price. The people who are supplying, the business entities who are supplying the funds, they are happy. Why? Because they are making the desired profit. So again, a win-win situation, a perfect balance has been maintained. So that was how we used to uh, give the definition of market clearing price, or for that matter, the equilibrium price. Market equilibrium has been reached. So again, money markets, they are also having the same function. They also perform the same function. Just another term will be utilized here, that short-term funding is involved. Next, we have it provides an avenue for central bank intervention in influencing both quantum and cost of liquidity in the financial system. So direct involvement of RBI will be there in Indian money market. And what is the function then? Fine. The function of money market is what? You can directly interfere in the market. So RBI, being the central bank of our country, can directly intervene in the market and try to extract the maximum benefit from the money market. And RBI wants to have a benefit in the form of what? In the form of transmission of its monetary policy. Fine. Okay. So at ground level, how the effects of monetary policy will be visible, it is determined by what? The efforts of RBI. But RBI also needs a platform. Now that platform is provided by the money market. Okay. So money market, I hope that the basics are clear. What is a money market? Short-term market. What are the functions? Three basic functions. First, it provides direct mechanism where there is a demand of funds and supply of funds in short term. Second, it also provides a price. Fine. Not only the demand and supply is met, but at the actual price, at that price where both the parties or all the parties involved are happy to pay. Third important pointer, which we have seen just now, that it provides a platform for RBI to intervene in the market and have its monetary policy transmitted. Okay. So all these points are the functions of your money market. Now let's move on to one by one what all are the instruments available in the money market, how the lending is happening, and how the particular entities are receiving the money. So it all starts with the call, notice, or term money. So this particular mechanism is more or less directed towards the banks. Fine. You will find that banks are involved here. When we talk about the lending function of the banks, fine, lending of the banks, they do to either individuals or the big corporates, right? But what about the needs of the bank? Bank also requires some money. So whether bank will ask you, or for that matter big corporates, for some kind of loan or not, answer is no. For banks, another mechanism is available, which is under the head call money, notice money, or term money. And the banks, when we talk about how the needs arise, they can be various in the form of, let's suppose, quick needs, quick funding the banks require. We have call money for that. Then we have the mid, fine, the needs who which are not that high, or for that matter you don't need the money for a longer duration of time. We have the notice money. Relatively you want some money for a term, fine, a specific term is there, that for, let's suppose, 3 months, 4 months, 5 months, like that. Then we have your term money involved. Fine. Again, short term only, but yes, the particular duration is more than call and notice. So what is the meaning of these three terms? Short-term liquid financial assets that are readily convertible into cash at low cost on an uncollateralized basis. There is no collateral whatsoever involved. Maturity ranges from 1 day to 1 year. A very simple aspect which is directly associated with the short-term funding. Who are the participants? Primarily, you will find that banks are there. Fine. The needs of the banks are being fulfilled under this particular money market. Then we have primary dealers also. Then DFIs are there. Also, when we talk about insurance companies, mutual funds, they can be the participants. They can be either the lenders or the borrowers. But when we say that which all are having the function of lending only, so lending only, we have the insurance companies, mutual fund, or the PF funds. All these are what they function only as lenders, and that to non-banks. Okay, so when we talk about the funding mechanism, how it works under call money. So you want quick money, you just do what? You call your friends, fine, that yes, I need some money, just give me or just pay me via the online payment. Fine, UPI, I'm sending it to you, just give me the money over this particular UPI. So quick money, you can say within 1 day. Fine. So the funds which are lent for 1 day, repayable on demand. Fine. Repayment, there is no specific criteria that when they will be repaying it, but mostly it is having the repayment as soon as possible. But what is fixed here, that funds are lent for 1 day only. Fine. So quick lending or overnight funding. Then we have notice money. Simply stated, they are lent for 14 days, fine, with the notice requirement. Like we say na, that we have put a notice on the notice board that yes, the timeline is specified that within 7 days you have to fulfill this particular task. Similar is the case with the notice money also, that within 40, if you want to have funding for 14 days, fine, uh, then you have the notice money with you. Next is term money. In term money, there is fixed maturity from 15 days to 1 year. Fine. So 1 year is time duration, which is not mostly involved in the term money, but the time period which is available is yes, your 1 year. So maximum can be 1 year or up to 1 year. Fine. That would be a better definition. Fine. So 15 days up to 1 year. So the maturity structure 1 day, 14 day up to 1 year, call, notice, and term money. What are the key features here in the call money, notice money, or for that matter, term money? Simply stated, we have the trading ongoing via the electronic screen-based system. NDS call system, we call it, and it is available on the RBI Direct portal. Fine, RBI Direct portal has a specific link for the NDS OM. Fine, we'll be looking into that also. But right now, how the uh, trade happens under these three mechanisms, call money, notice money, or for that matter, term money via the RBI Direct portal, the electronic screen-based system. You will be transferring certain funds, right, via electronically. Settlement happens electronic fund transfer using the RTGS, and repayment also happens through the RTGS only. Fine. So electronic system is at the helm of your entire call, notice, and term money. What is the example here? You can see in the last line, it is mentioned that supposingly bank ABC is there. Fine, one bank is ABC. It borrows 50 crore for 1 day at, let's suppose, 6.5% in the call money market. 1 day, for 1 day, you will be utilizing which market? Call money or notice? You call, notice or term, you will be utilizing the call money, right? So call money will be there for 1 day we are talking about. The funds involved are 50 crore. And what is the rate of interest which has been finalized? It is 6.5%. Settlement will happen how? It will happen via the RTGS, real time. No time lapse will be there. The settlement will happen within the same day. And when we talk about the overall prudential limits, how the prudential limits are defined, they are defined for various financial institutions. So scheduled commercial banks for call and notice money, how the limit is decided? 100% capital funds on daily average. Daily average means what? Supposingly, you have seen that from the past week's Monday till the past week's Friday, what all lending has been done to a particular bank. Fine. This is your bank, and you have received the funding from a particular entity, and now you want more money. So how you can take under the setup of call and notice money, just the average of the previous days we will be taking it, and whatever the amount comes out to be, that amounts 100%, fine, amounts 100% will be the funding available under the call or notice money setup. If you want to have per day a particular amount, that yes, I want that the funding should be met according to the per day amount, then 125% of that particular amount, supposingly between Monday to Friday you choose Thursday, I want the amount with respect to the Thursday amount I have received, so 125% of the Thursday's amount you can have right now. For term money limit, it is approved by the internal board only. Payment and regional rural banks, the RRBs, 100% capital funds, daily average you will find, or for that matter, 125 of any day. That is again the same as was mentioned in the scheduled commercial banks. For term money, the limits are specified by the RBI. Fine, payment and regional rural banks, the RBI will be specifying the same. For cooperatives as well as your primary dealers, the limits are exactly the same for call, notice, and term money. 2% of aggregate deposits for the cooperatives, and when we talk about the net owned fund for the primary dealers, it is 2 to 5%. Okay, so a very important point I would say, whenever there is a question based on your call notice or money, call notice or term money, you will find the question from this particular table only. The table is very, very important. Do not miss it at any cost. Next, when we talk about the RBI NDS-OM, what is the negotiated dealing system? Simply stated, whenever there is the NDS-OM, you will find that it is just a electronic platform. Fine, one electronic platform is there, which is regulated by the RBI. On the RBI retail portal, you will find this particular NDS-OM. And when we say the order matching portal or the NDSOM portal, whether you need any email ID or password for that, yes, you have to first register on the RBI Direct, and then you can just simply log in using your email username or mobile number along with the password, and then you can participate in the call money, notice money, or term money operations. The NDS negotiated dealing system is an electronic platform by the RBI for trading the government securities and money market instruments. Fine. So most important part is that government securities are being traded here. Fine. Introduced in 2002, it aims to enhance transparency, efficiency, moving away from telephone based trading methods. Now it is totally electronic, fine, electronically the trade is happening. Earlier the telephone based trading method was adopted. When we talk about NDSOM, the negotiated dealing system order matching system was launched in 2005. This portal, you can say, has its roots from 2005. It enables anonymous order driven trading in government securities, so that there should not be any speculative trading. Fine, speculative trading means that you know that a particular person has provided for this information, and now you will be trading in that particular uh, you can say security only and earn more money, so that the various markets which are trading at the same time for that same market will be having the loss or profit according to your needs. So speculative market should not be there. That is the primary reason why we have shifted to the electronical electronically based trading. NDSOM has direct and indirect members both, with different access levels to trading and settlement features. So direct members, you will be having the uh, primary dealers as the direct members, and indirect members, those who will be registering on the retail site of RBI. It includes primary market module for auctions of government securities and also the secondary market module for reporting over the counter trades. The OTC trades, you can also have the reporting done via this particular NDS system. And your primary market, as you know, the government securities will be auctioned there. Fine. Now let's move on to the treasury bill. What is treasury bill? Directly you can decipher from the word itself. Treasury comes from the um, the particular expanse of funding available to a particular government. Fine. So treasury bills, mostly you will find that these types of questions, with the questions which are asked from the money market, they revolve around the treasury bills. The short-term debt obligations of the government of India issued to meet government's short-term funding needs. Simple. That government wants money, fine. They can do what? Can they approach the banks directly? No. They will be operating via the government securities. They will be telling the banks or issuing a security document that yes, this is the amount involved, this is the tenure, and this is the rate of interest you will get. The banks, or for that matter, RBI via the banks will be floating these securities, and the general public will be buying the same. And they will be very much happy. The general public will be happy to buy it. Why? Because it is being awarded by the sovereign government. So what are the types and tenors of these bills? For 3-month maturity, you have 91-day T-bill, 182-day bill, 6-month maturities, 364-day, you have 1 year maturity. These are the three timelines which you need to remember: 91, 182, and 364. Fine. Now, what are the key features? Settlement, it happens on T+1 basis. It is not that today you are, giving the particular money for having the securities credited in your demat account, and within the same day it will happen. No, today is what? Today is Thursday. So if you have initiated in Thursday morning, Friday you will be able to have the access to your government security, and your demat account will automatically reflect a debit of the amount which is involved in this transaction. Minimum amount involved is 10,000, and after that you need to go with the multiples of 10,000. So like 20,000, then you have 30,000, and so on. Pricing, it is quoted at discount price. Now what is this discount price? Simply stated, discount price is a price which is not the actual price. Fine, it is not at all the actual price. Fine. You are having certain discounts, that is why the scheme looks lucrative to you, no? And same goes for the government securities also. They are lucrative to the people of our country. Why? Because some discount is being provided, and it will ultimately reflect in the final profit. So the return is what? Difference between issue price and the par value. Now comes the question that what is issue price and what is the par value? Now simply stated, your par value is the value which you will find, which is set by the issuer, usually indicates the minimum worth. Fine. The minimum worth of a particular asset. This is the minimum worth of your asset. And issue price is what? It is the price at which it has been issued to a particular entity. And the difference between this will give you what? More or less the discount only. Fine. The actual price which it has on the time of selling it. So the par value and your issue price, once you subtract the both, you will get the ultimate return. Fine. Supposingly we have one example where the price of a particular share is 100 rupees, but it has been issued to you for, let's suppose, 90. So what will be your profit? Profit would be 100 minus 90, that is 10 rupees. And why we are saying that this is the par value, or this is utilized in the government security mechanism, or for that matter treasury bill? Because the government will sell the same amount, the same bill to you for 90 rupees, and it will purchase back from you at 100 rupees. Fine. So although the value of the bill is 100 rupees, you will be paying 90, and in return, once you return the bill to the government will give you what? The interest amount along with the actual amount involved. So you will be having 10 rupees benefit. Over the top of it, some interest also will be paid to you. What is the form? So the form is simply it is issued and redeemed at par value. Fine. Issued also as well as redeemed at the par value. Participants can be state government, UTs. Then we have eligible provident funds also, designated foreign central banks, Nepal, Bhutan, and Russia. They are having their central banks, so they are designated to participate here in the Treasury Bill of India. Then individuals also, but when we talk about the individuals, they have a particular cap that is 5% on the RBI retail direct portal. Out of all the securities, only 5% are open for the individuals when it comes to the no, to the competitive bidding. Fine. Right. So when we talk about the bidding process, it happens in two form: non-competitive and competitive bidding. So both the bidding types are different. Competitive bidding means what? You have a market where there is no fixed price. Fine. Some entities will tell you that yes, we can give you for 100 rupees this particular security. Some will say that no, since this is a bidding, let me provide the same service at 90 rupees. So this is what competitive bidding. But when you talk about non-competitive bidding, here simple aspect is that the prices are fixed. No speculation or manipulation can be there. So limited to specific participants, amount is fixed by the RBI. Cutoff price is also known and it is easier for the retail investors. But when we talk about the competitive bidding, what is happening here? Open to all the participants, but no amount limit is there. Bid at desired price, whatever you want. There is higher risk as well as higher return. Fine, speculation, you can say indirectly, the competitive bidding is going on. Example of the T-bill. So supposingly government issues 91-day T-bill at 9800, which is the discount price. Fine, the customers will have it at a discounted price. Investors will get 10,000 after 91 days. After 91 days, the investors will be having 10,000. So what will be the return here? The return will be 200 per 9800 invested. Fine. So since the minimum amount is 10,000 and then multiples of 10,000 are there, so that is why we have taken the example of 10,000. Also you can have 20,000, 30,000, 40,000, like that, the denomination of your T bills. Okay, so I hope that this thing is clear, that how the T bill functions and whatever participants are there and how the bidding is done. What are the types of T bills? That is also very, very important. Next comes the certificate of deposits. Now, certificate of deposits, you can directly equate it with the other deposits which are being floated by the banks. Other deposits being what? You have the fixed deposit, fine, the FD is there, or for that matter, RD. But how you can equate it with the certificate of deposit? Simply stated, these are the negotiable instruments, fine. The certificate of deposits, these are the negotiable instruments. And when we talk about the certificate of deposits, whether they are issued by any bank or some specific type of banks, they are issued by the scheduled commercial banks. Fine, to the individuals only. But the important part is that there is not at all mention of the return. Fine, return, what a return you will be having, it is not certain. Like in FDRD, what is that? Your percentage is fixed, that this particular return you will have, but it is not directly mentioned out in the open that your certificate of deposit has this particular rate of interest. You will be having normally higher rate of interest as compared to FD, but again, it is not a well-known product. And similar to your certificate of deposit, we have the commercial paper also. Find the comparison between the two. The CDs are being issued by your banks, scheduled commercial banks, whereas commercial paper for some money, for making money out of the market, are being issued by the corporates. Right. So both of them are short term in nature only, but the thin line of difference is issued by the banks, issued by the scheduled commercial banks and some selected all India financial institutions which are permitted by RBI. We have the CDs. For commercial papers, we have only the corporates who can trade in that. So what is the meaning? Negotiable instruments in dematerialized form issued by scheduled commercial banks, including RRBs and SFBs, and selected all India financial institutions which are permitted by RBI. So the issue will be done at discounted rate, fine. Redeemed at par value. That is the reason why you will make good profit. So par value and discounted rate. I hope you understood in the last. Fine. When we talk about the tenure, so tenure lasts from 7 days to 1 year. More commonly, 3 months, 6 months, 12 months, like that. One important aspect is that if you do not want to, if you do not wish to continue with the certificate of deposit which you have purchased from the bank, you can return it. Fine. So there is a return window which lasts till 7 days. What is the eligibility here? So it is issued to individuals, non-minors, fine, minors are not allowed, corporations, companies, trusts, funds, NRIs. Minimum amount is 5 lakh. And overall, when we talk about what can be the maximum amount, so 5 lakh plus the multiples of 5 only. Multiples of 5 will be what? Plus 5, or for that matter, plus 10, plus 15, like that. Okay. What are the key features? So the loans are allowed or not on your CD, certificate of deposit. So not allowed against the CDs unless RBI permits. But mostly you will find that commercial deposit, your certificate of deposits do not have that setup. Bank buyback is involved only 7 days after the issue date. Fine, we have seen this. Negotiable, it can be transferred in the secondary market. In the secondary market, you can negotiate, but again, it is not that prevalent in the secondary markets when we talk about the life cycle of CD. So banks issue the CD, investor holds it, and at maturity redeems it, just like the FD, but with a higher rate of interest. Next, we talk about the example. So supposingly the investor buys certificate of deposit at 10 lakh, fine, at 8% per annum for 6 months. Fine, that is the duration. So redemption value will be what? 10 lakh 40,000 after 6 months. Right. So a very important point which you must note, 8% per annum. So half yearly will be what? 40,000. Okay. So when we talk about the rate of interest which is offered by such CDs, it is higher as compared to the other deposits. Next comes the comparison of your CP, that is your commercial paper, as compared to the CDs. So meaning is what? Simple short-term borrowing by the corporates they want to buy, then they have the option of commercial paper. The borrowing can be done by the corporates, raised by the corporates by issuing the CPs. Launched by RBI in 1990, it is just an unsecured instrument. It is not secured at all. And it is issued as promissory note, the P notes as we call them. Fine. Promissory notes, which we have studied in the principles and practices of banking, one of the negotiable instrument only at discount. So all these instruments which will be floated in the market, they are at discount. Only then the customers will buy. If they are not at discount, who will buy them? Okay, the issuers will be companies with certain conditions. NBFCs, All India Financial Institutions, can issue on the standalone basis also. Like there is no, you can say, designated number of individuals which have to float this CP. Single individual, one individual can also go and you can say transact the commercial papers or trade via the commercial paper. Now, very important aspect, since it is not having any backing of government or for that matter RBI directly, so credit rating is involved here. So for all those CPs or for that matter the companies who are issuing the commercial papers, they must have a minimum A3 rating. Fine. What is this A3? Like the individuals, for individuals we have the credit score. Fine. Credit score is there. Credit rating is for the companies. And when we talk about SEBI registered CRAs, they must check this particular company and the rating of that should be minimum A3. Now comes a particular aspect which has been asked multiple times in the examination. When we are issuing an amount of greater than 1000 CR via the commercial paper, when we are uh, having this sum of transaction greater than 1000 CR, then rating will be there, but from two CRAs. And supposingly we have the two ratings. One CRA says that yes, the rating for this particular company, you can lend for, let's suppose, only 9 months. Another says that only 8 months you can lend to the company. So the lower rating, the rating which is lower out of these two, specifically for the time duration also, we will be finalizing that. Okay, but for the issue greater than 1000 CR, term duration will be what? 7 days to 1 year, not beyond the credit rating validity. Right? Credit rating is supposedly valid for only 8 months, and you are giving the particular, you are issuing the particular CP for, let's suppose, 10 months. That won't happen. Amount limit set by the board or the credit rating agency only. Overall limit is 100% of the company's net owned fund. Right? Overall limit of your CP will be 100% of the net owned fund. Now, whether there is a buyback involved or not, yes, like in your certificate of deposits, it was 7 days. For commercial papers, the buyback is 30 days. Okay. So CP requirements, let's just quickly revise. Minimum A3 should be the credit rating. Term should be 7 days to 1 year. Limit 100% of the company's net owned fund, and buyback 30 days from the issue. Who are the holders here? Holders will be individuals. Fine. Individuals are buying from the corporates. Banking companies can also buy, or the registered bodies. NRIs or FIIs, yes, they can, but under certain FEMA rules, subject to your SEBI limits. Fine. NRIs, then OCIs, also your foreign portfolio investors, but with certain stipulations. The holders will be what? Your we have just seen the holders, individuals, banking companies, registered bodies. Then one important aspect is standard asset classification. This should also be ensured while issuing the CP. Any fund-based facility from banks or financial institution is classified as standard asset by all the financing banks or institutions at the time of issue. Find the particular fund-based facility, if being availed, should have the classification of the asset as a standard asset. Now, let's just quickly have one more example related to CP. Supposingly a company ABC is there with A2 rating, issues CP for 50 crore at 8.5% per annum for 90 days. Fine. So investor will do what? They will buy at discount, receive the par value at the maturity. Fine. So simple. When we talk about how the CP looks, it looks like this only, that they have issued the CP commercial paper for this amount at this rate of interest and for this particular time period. And the investor will do what? They will ultimately buy at discount only for making profit. And ultimately, this price which they will be paying will be much lesser as compared to the actual price of 50 crore. Over the top of it, you will receive the value at the maturity also by adding the rate of interest involved. Fine. So this was it for today's class. When we talk about the theory, the concepts, we have seen the money market. Fine. We started off our discussion with the money market, the basics of money market, what all features are there, what are the functions of money market, what do we mean by call, notice, term money. Then we switched on to your NDS, which is very important to know that whether RBI is participating directly or not. So yes, in India, RBI retail website is there, and from there only you will be able to participate in the call, notice, or term money via the NDS platform. Then we have treasury bills. Discuss the treasury bills, three types: 91 days, 182 days, 365 4 days. Also, the certificate of deposits, the CDs, very, very important. The key feature here is the buyback 7 days, along with that minimum amount 5 lakh. Over the top of it, you can add the amount, but with the multiples of 5 only. Plus, when we talk about the commercial papers, the CPs, the funds being raised by the corporates only. But the important aspect is credit rating. The CRAs must have checked the ratings of that particular company who is raising the same amount, and the minimum rating should be A3. And what is the buyback time limit here? It is of 30 days again. Fine. Now let's try to solve the questions, which is very important for our examination. First question, what is the call money lending limit for scheduled commercial banks? Daily average basis. Fine. Daily average basis, and one was what? The overall weekly average. So for weekly average, it was 100%. For daily average, what was the right answer? 50% of capital funds, 100% of capital funds, 125% of capital funds, or 225% of net owned fund. We have seen for the daily average, it is what? 125, 100% of capital funds, fine? 100% of the capital funds for the daily average. Let me just give you. hmm, Here you can see 100% for the daily average, and for any day you can have the 125%. So B will be the right answer here. Fine. Next is, what is the maximum CP, the commercial paper issuance limit, as percent of issuers net owned fund? So a very important question again, issuance limit. The maximum limit will be what? 50% of NOF, 75%, 100%, or 200% of the NOF. The maximum. Here you can see now the CP we have just now studied. Fine. The limit is what? 100%. C is the right answer. Next, when can banks buy back their own CD? So the buyback will be what? Anytime you can give them back. Only after 7 days, after 30 days, or never. So the buyback time period will be what? Option B, after 7 days. What is the minimum credit rating required to issue commercial papers? Now, when we talk about commercial papers, the minimum rating should be A1 plus, A2, A3, or BBB provided by the CRAs, credit rating agencies. It is what? Yes, it is your A3, option C is the right answer. Then we have, which of the following statements is are correct regarding the prudential limits for call and notice money market in India? So the scheduled commercial banks can lend up to 100% of their capital funds on daily average basis. 100% on the daily average basis. Then cooperative banks lending limit is 2% of their aggregate deposits. Only the cooperative banks we are talking about here. Primary dealers, yes, indeed, they have the limit of 2 to 5% of net on fund on daily average basis. What about the payment banks? They have no specific limit prescribed by the RBI. RBI has specified the limit. Now, what is the limit, by the way? And the right answer is what? Option A, 1, 2, and 3 only. Scheduled commercial banks, 100% of capital funds. Cooperative banks, 2% of the aggregate deposit. Net on fund, 225% for primary dealers. And your payment banks, what is the right answer? Just quickly revise again this table, a very, very important one. For your payment banks, it is again for term money as per the RBI norms. For call and notice money, same 100% capital funds on daily average. Any day, 125%. Let's get started. First of all, what is a capital market? So in the past, we have seen that financial system, or for that matter, specifically when we call it financial market, contains various sub markets, the most prominent being money market. Next comes the capital market, then we have derivative market and the mutual funds. These are the major ones, you can say. Apart from that also we have 4 or 5 more markets, but the most important ones are these. In the money market, that is the first one, you will find all those monetary instruments being traded, which are ultimately deciding the, or for that matter, utilized by the RBI for its monetary policy transmission. And the most important part of the money market is that they are short term in nature. And all those security, all those instruments are short term in nature. On the other hand, when I switch to the capital market, we will say that all of them are long term. Fine. The instruments involved are long term instruments. So what is the time duration? It will be greater than 1 year. First important aspect of capital market. Second important part, when we say that the capital market is open for all, so we mean to say that you can trade openly. Fine. There is no restriction whatsoever. Obviously, there will be some legality involved, some restrictions for the illicit activities, but overall, when we call about for the capital market, it is open for everybody whosoever wants to have the transactions between the securities involved. And when we try to classify the capital market, it is of two types. First one being your primary market. Second one is your secondary market. What is primary market? Primary market simply means that a company has issued certain shares. Fine. Company, let's suppose company A has issued certain shares, and these shares have been issued to some investors. For the first time, a company has floated its shares in the market and they have been issued to the investors. This type of transaction of the instruments, or for that matter securities, can happen under the primary market. Fine. For the first time it is happening. On the other hand, when we have a pool of investors, fine, investor 1, investor 2, investor 3, so on, who are holding the shares of a company, fine, already they are holding what? The shares of a company. They already have the shares, fine. And now, when the trading happens between these investors, not between the company and the investor, between the investors themselves, then we say that all such transactions will be categorized under a market known as secondary market. But mind it, both of them are what? They are a part of capital market only. Fine. Till here, if everything is fine, then we can move on to the further classification. So when we say that primary market is primarily divided into two types of markets, first is public issue, second is private placement. So whenever the company is floating its shares in the market, and the shares can be purchased by anybody, right? Publicly, anybody can purchase those shares. Such kind of market will be known as your public issue market. Under the capital market, or for that matter primary market, will be known as public issue market. But when I say that there are certain shares, securities being issued by the company for a specific group of individuals, and the name for them is QIBs. Fine, we'll be looking into QIBs also, the institutionalized buyers. So when a particular group is only being allowed to access such kind of shares, or the trading will happen with this group only, then we are talking about private placement. Privately, you will be holding a particular set of shares, and it can be forwarded only to the specific group, not to the public in the open. Right? So primary market, two types are there, majorly two types. For secondary market, we will be having mostly the secondary market, as we call it, the stock market also. Fine, secondary market is uh, operated via the stock exchanges only. So stock market also you can call it. And for the classification, we will be looking into auction market and dealer market. One type of market which is ongoing via the stock exchanges is known as auction market. There will be auction bidding will be there. Second type of market is the dealer market, where a dealer will be involved in the overall transaction of your shares. Right? So secondary market, auction and dealer. The auction market, more or less stock exchanges, and over the counter is the primary, you can say, primary example of your dealer market. Okay. So capital market, till here you should be able to understand what specifically entails to primary market, what is a secondary market, what is the classification of the both, further classification. Why I'm telling you this again and again? Because in the examination, there won't be any definition as such. Fine, they won't be asking you the definition, the simple definitions. But whenever there is a case study based question, there, if you do not know the specific meaning of these terms, then you will get confused. And in order to nullify this confusion only, you must know each and every definition with examples. Okay. So yes, that is the aim of us, ours also. We want to give you the most crisp and concise study material. So now let's move on to the elaborate discussion of capital market, starting off with the basics. The basic starts with the definition only. As I've already told you, I've already told you that the capital market is a long-term market as compared to the short-term market of money market. So capital market, it is just a financial market in which long-term debt or equity backed securities are bought and sold. What is happening in a capital market? Simple, two transactions are there. Only two transactions will be there. One is buy, another one is sell. Apart from these two, can you list any other third transaction, third kind of transaction? No. These will be the only two transactions. And how you will be doing the buying or selling, that will be governed by the capital market. But which commodity are we buying or selling? That is the question, right? So we can buy or sell certain securities, right? The securities, like shares we call it, na? Certain securities. The broader term is security. And these securities are having inherent feature of two types. One is the debt security, fine, debt which will be backed by certain securities. And second one is equity. Fine. Primarily, these are the two terms which you should know. Basic meaning. What is debt? In credit market, we know for sure that debt is a kind of loan only. Fine. You are talking about certain loan. So whenever an investor is investing in your company via debt. So they are doing what? They are providing you certain amount of loan. And this loan will be more or less paid back to this particular investor by the company in which the investor has invested. So that is the reason why in debt you won't find any kind of risk. Fine, risk is minimal here until and unless the company goes bankrupt and you are unable to recover any dues. Normally it does not happen, but yes, that is the only risk involved. But in equity, what happens? You provide some shareholding, right? You hold certain shares within that company as an investor. Now, when there is a profit to this company, you will be very much happy. Fine, you are happy because you are ultimately one of the shareholder. But as soon as there is loss, so the sadness creeps in and you will find yourself in a bad investment. Right? That is the reason why equity is risky. For whom? For the investors. For buyers, is it is okay, fine. They are anyhow making losses only. But yes, for investors, it is not that much advisable. Fine. Equity, both things can change the course of your investment in the future in any company because your funds are also at stake. But in debt, you will be able to manage all your funds because you will be repaid via the loan structure. Fine. So debt and equity, I hope that these two terms are clear to all of you. So financial market in which long-term debt as well as equity-backed securities are either bought or sold. It is a market for long-term funds, maturity more than 1 year. Fine. And when in this particular market, the flow of securities is like this, that a company, that is the first step, a company will forward the securities to an investor. Right? The first step is company, then the second stage, the investor is there. If this is the flow of the securities, then we call it as a primary market. Okay. Second one will be that there are n number of investors. So investor A is providing the securities to B or vice versa. If such a flow is happening in the capital market, we are talking about the secondary market. Right? So simple terms, you must be clear. So primary market, what is the another name? It is also known as the new issue market because the company is providing direct access to its share to the investors. Securities are offered to the public for subscription for the first time, subject to the guidelines by SEBI as well as Companies Act, because we are talking about the shares of whom? Of the company. So Companies Act will be there, SEBI regulations will be there. Direct flow of funds from investors to the company. Directly from the company, the particular shares will be forwarded to the investors. And in return, the company will get what? Company will receive the money. That is the reason why they are floating in the shares. Next is your secondary market, which is commonly known as the stock market also. So trading of pre-issued securities will happen here. Fine. You will find that all the securities which are being traded in the secondary market, they have already been issued. Now, second time or third time, or you can say not a first time, these securities are being traded with among the investors. Participants are mainly the investors only. Investor 1 buys from investor 2. But why? What is the reason? Because we want some liquidity. Fine, investors want some liquidity, so they will be having the transactions, or for that matter, trading of the pre-issued securities in secondary market. Also, price discovery. Fine, whenever there is buying or selling of any kind of commodity, a particular price will be charged for the same. Fine, buying or selling, and this price is what? Ultimately, a long term amount which will determine the worth of that particular share, right? And ultimately, when we talk about the worth of a share, the long term pricing will be backed by this particular amount only, because we do not know for sure that yes, this share's price will remain the same, or for that matter, it will remain constant. No, it does not happen. So price discovery mechanism also, you can utilize that mechanism while determining the pricing of your secondary market securities. Now let's see one question, a very simple one. In an Indian primary market, Dash does not have any role in price fixation of an issuing the share. So the first option is SEBI, Securities and Exchange Board of India, issuing company, merchant banker, or none of the above. So when we say the primary market, this flow chart should be there in your mind. We have a company and the securities are being forwarded to the investors. So issuing company has a role in price fixation. Yes. So this is wrong. B is gone. Then the transaction which is happening, it will be via the merchant banker. This is also gone. Then we have SEBI. Fine. SEBI is what? SEBI is the regulator. Along with the Companies Act, we have seen that SEBI is also involved in regulating the primary market. Okay. So SEBI will be the right answer. That is option A, because the question says does not have any role. So SEBI is not having any role in price fixation. So A will be the right answer. Now let's move on to the commonly used terms. See, whenever there is a new topic to be studied, like today we are studying the capital market, and which has some terms which we do not use in the common parlance, then it makes much more sense to know these terms. So first of all, the tax which is being mentioned again and again whenever there is a transaction of securities, because we are doing what? We are transacting the securities only. And for such transactions, you have a specific tax known as security transaction tax, a tax levied on all the transactions done on stock exchanges. So you will find this particular tax on the securities traded under secondary market. In secondary market, it is effective since 2004. And recently, on 1st of Feb only, our government has increased the STT in our country to 0.05%. Earlier it was 0.02%. On which type of transactions? On the FNO, futures and operations. Right? So a very important point which you must note. And reason of increasing the tax because FNO has good amount of speculative trading also, and in order to discourage such speculations in the market, the finance minister has increased the tax. Right. Next is rolling settlement. Now what is this rolling settlement? The trades are settled based on the net obligation. So the securities are being traded. That is what is happening in the financial market or the capital market specifically. And these securities do not uh, have the real time transaction as compared to the you can say the transactions happening in the banking system. In banking, what happens? You try to transfer the funds via RTGS. Fine. So real time gross settlement is there. But in your securities market, the investors will be giving what? Money. Fine. Money will be debited from the investor's account, and the demat, dematerialized account of these investors will be credited by the securities, right? So this money, although will be debited today, but the settlement or the securities will reflect in this demat account of the investors after 1 day. So T plus 1 is the time limit. And this is what is known as your rolling settlement. That trade will be settled when both the parties have what they wanted. So the trade was that one. Here you can see the trade is what? There is one investor who wants to buy the shares, and then there is a company who is doing what? The company is trying to raise money. These are the two needs of the specific, you can say, parties involved in the security market. So the trade will be done away with once both the parties get what they have. So investors will start the overall process from where the money will be debited. That is just a one stage. The second stage or the final stage would be settlement. Fine. The settlement will happen when the shares are being issued to this particular investor, and this process, overall process, is known as rolling settlement. And in India, the timeline states that it will happen on T plus 1 basis. So the settlement phase will be final transfer of ownership. Pay in, pay out of funds and securities are completed. Fine. The funds are also being debited and the securities have been credited, like that. The buyer receives the shares in demat. The buyer is what? The investor. And seller, the company, receives the funds in the bank. And if we are talking about the secondary market, fine, in the secondary market, what will happen? The investor who wants to sell the security, fine, the investor who is trying to sell the security in lieu of money, fine, and there will be the second investor who will be buying the securities and they will be giving their money. So once this transaction is complete, investor one gets the money and the buyer or the investor two gets the securities. We say that the settlement is now over, or for that matter, this trade has been settled. So rolling settlement T plus 1. Next comes pay in, pay out. What is pay in? Simply stated, when the brokers make payment or delivery to the stock exchanges. On the stock exchanges, we are having the operations of secondary market. So whenever the brokers are making the payment in lieu of securities, or for that matter, whenever the brokers are giving you the delivery of securities, giving whom? Giving to the stock exchanges, then it is known as pay in. And payout is what? When the security exchanges makes the payment or the delivery to the broker. So if the broker is initiating either the payment or the delivery, then it is known as pay in. Payout when? Payout will be when the stock exchanges will start making the payment for the delivery given by the brokers, or the stock exchanges are giving the delivery to the uh, brokers who are making the payment. Right? So pay in, pay out. Then we have another term known as SLS, Securities Lending Scheme. Now, what is this scheme? Simply stated, there will be certain ideal securities. Now, when we talk about the two investors, I1 and I2, there will be certain securities lying with I1. Fine, one portfolio is there for I1, where you will find that certain securities are not being utilized by this investor, that is I1. So these securities are not being traded for any kind of, you can say, activity, buying or selling. So they are lying idly in the I1's portfolio. Now, when we talk about the investor I2, investor I2 has predicted that in future the share price of, let's suppose, XYZ security will fall. In future, the price will fall. Now, I2 will approach I1 that since your securities are lying idly, you can lend them to me. I want to utilize them for my trade. I1 will say, okay, since I am not utilizing them for a longer period of time, I will lend it to you, but in lieu of a certain fee. Now I1 will be paying, I1 will be giving the securities to your I2, the idle securities to I2, and I2, once the trade is over of this particular future XYZ, then I2 will pay the fee to I1. Okay, and this particular setup involves certain risk. Risk of what? Risk of not able to repay. Because what is going on here? See, I2 is doing what? Utilizing these idle securities for such a transaction for which I2 feels that the prices of this share will go down. But what if they do not go down? Or for that matter, what if they are going down, still I2 is unable to pay the fee he or she promised to I1? Fine. So in order to have a secure environment for such transactions, we have this securities lending scheme where in between these two investors, you will find a third party. And this third party is what? Your clearing corporation. So clearing corporation of India will act as a central counterparty, guaranteeing settlement and removing the counterparty risk for both the sides. So when we talk about the scheme, that is your securities lending scheme, there will be the lenders who will be placing lend orders specifying the quantity and the expected fee, quantity of the security and the expected fee, whatever they expect. Borrowers, when we talk about the borrowers, they place the borrow orders specifying a quantity and fee they will pay, because fee will be paid by the borrowers only. And ultimately, this whole setup will be enabled by the clearing corporation. And this assurance of the order matching, that yes, whatever you wanted, you get, whatever lenders asked for, they have received. This assurance will be done under the SLS scheme. Automated order matching will be done. Now comes a point. Here you can see that, okay, we understood that lenders are there and there are certain borrowers, and these borrowers are buying for what? For the future. right now they will be utilizing your idle securities, but they have predicted that in future some XYZ price share will go down. And this process via which they will be benefiting or making profit of this lower price in future is known as short selling. And this is the reason why they borrow it from the lenders. Fine. So borrowers borrow for short lending. Okay, short lending. Simply stated, it is a particular process via which you are not completing the cycle of selling, short selling. Right? Short selling, you are just exiting the market before the process is complete. Right? You are exiting the market. How? So the step one will be the borrowers, or for that matter, those individuals who are doing this short selling, they will identify some share prices which can go down in the future. Once they have identified this, they will go to the borrower and under your securities lending scheme, they will buy the securities and pay the fee to the lenders in future. Now, once they have these idle securities, what they will do, the borrowers, they will sell them in the market. Right? But since these were the idle securities, not at all utilized by the lenders, they can trade them fine, very easily. Once these idle securities are in the market, they will wait for the price drop because that is the first thing. Na? They have identified that yes, price drop will occur. And in the next step, they will do what? They will buy back at a price which is not that high. They are holding the securities. They have not sold them all. The transaction is still in between, or for that matter, the transaction is not still complete, and they will buy back the security. Now, what will happen? Once the buyback is initiated and the prices, which you will see here in the example, also will be looking into, you will have the return or the profit. Fine, because see, in this particular case, let's suppose the current market price was 1000 rupee share was there. So in the first phase, what these individuals doing the short selling will do, they will buy the shares at rupees 1000. Right? So 100 shares are there and they are paying just a fee to the lenders. Now, since the price of this particular share will go down, but the listing was done at 1000. So what will be the total cash inflow here? It will be 1 lakh. Now, since these were only the idle securities, the actual owner of these securities, he or she is not at all concerned about what is happening in the market. They are only concerned about one thing, that is the fee which will be paid by the lenders. Now, once the price starts to plummet, starts to drop, that is stage three, they will exit the market. Fine, enter and exit before, fine, exiting before the proper selling off of the securities. So here the cash outflow will be what? 85,000. So you have in your wallet, you can say, just for your imagination visualization, the cash inflow was what? 1 lakh. The outflow pertains to only 85,000. And that is the reason why you will be making the profit of 15,000. So via short selling, the individuals are making good profit in a single transaction itself. That is the reason why SEBI has stringent guidelines for this short selling in our country. A very important point to note. Okay. Now let's move on to the types of capital issues. So capital issues you can have via three types. One is public issue, then we have a right issue, last we have the private placement. So when we say that public issues is there, simply we are doing what? It includes new investors to the company. So the company is issuing the shares for the general public, fine, open to all. This particular issue is open to all. Fine. So disclosures must follow the DIP guidelines, disclosure and investor protection guidelines. What are these guidelines? Not that important for our exam, just the guidelines to protect the interest of the investors. Now, public issues can happen in two ways. First of all, it is IPO, initial public offer, where unlisted company will be offering the securities to public for the first time, right? The first time. That is your IPO. Then we have FPO. In FPO, you will find that listed companies make the fresh issue to the public, right? Fresh issue. Now the company is listed, so they will be making the fresh issue for the public. The unlisted ones, we have the IPO. So follow-up public offer will be when we are talking about the listed company, initial public offer for the unlisted company. So IPOs, you must have heard various startups, they have initiated their IPOs. Starting off with the Paytm was there, the major names when we call them. Then Zomato was also there. Then recently, I think Lenskart has also done the same. And various startups. The prominent examples are these only. Fine. Next, we have rights issue. How the rights issue is different from the public issues. See, the public issues offered to the public, fine, fresh issue. But rights issue will be offered to those individuals only who are already the shareholders, already the shareholders. Fine. When we say that the shareholding is not at all restricted, that is your public issue. When there is certain clause for the shareholding, you will find that we are talking about rights issue. So issuing fresh securities to the existing shareholders only, restricted for the existing ones only, usually issued in the ratio of securities already held. So you have a particular ratio and you will be maintaining that only. For example, a 1 is to 2 rights issue mean one new share for every two held. Supposingly, company that is Lenskart only, it has issued the public issue share under the IPO for let's suppose 200 rupees, just for the example. And there was one investor Ram who has bought the shares. Fine, 100 shares Ram has bought. Now, when the Lenskart will offer new shares, fresh securities to the existing issuers, existing shareholders, then Ram's name will also be there in the list. Fine. And when we talk about 100 shares, if Ram is holding 100 shares, so how many shares can be issued under the rights issue to Ram? It will be decided on a basic calculation of ratios, right? Which various ratios will be involved. So let's suppose Lenskart has finalized that we will be issuing 2 shares per 4 shares. Fine. 4 shares are what? The existing shares, if you are holding are 4, we will be providing you 2 shares. Or for that matter, it is 1:2. For every 2 shares you are holding, we will provide you fresh securities, fresh shares in the ratio 1:2. So for Ram, who is holding 100 shares already, under the rights issue, when the Lenskart will issue the fresh securities to the existing shareholders, Ram will get how many? 50 shares. And likewise, same will be calculated for other investors also, other shareholders also. Fine. Next, we have the private placement. So public issue for the public, rights issue for the existing shareholders. Private placement is for the selected group of persons. Fine. You are issuing the shares to selected group of persons only. And these persons, they are mentioned under Section 81 of the Companies Act. Fine. Okay, so yes, private placement also a very important area which from which the examination in your examination, the examiner will ask good amount of questions. Let's just quickly see that what all we have to read in this private placement. Starting off with the quip. qualified institutional placement. Simply stated, it is a process. Private placement is a concept, but how it is being institutionalized in the securities market via QIP. So it is a way of listed companies to raise capital by issuing the securities only to QIB. This is QIP, but we will be issuing the securities to whom? To the buyers, qualified institutional buyers. So these are governed by SEBI guidelines of 2006. Low procedural requirement is there because already you are having the selected group of persons listed in Companies Act only. Managed by a merchant banker. Merchant banker will be involved because we want to have a strict regulatory framework. These are the QIB who are included in the qualified institutional placement. Majorly, you have to remember the public financial institutions which are mentioned under Section 4A of Companies Act. Scheduled commercial banks are there, mutual funds registered with SEBI, FIIs and your sub accounts registered with SEBI only, venture capital funds, insurance companies registered with IRDAI, the insurance regulator, provident fund and the pension fund, where the corpus you must remember. The corpus is 25 crore each, the minimum one. Okay. So yes, this was it for today's class. If you have any doubt regarding the capital market, feel free to ask me and try to answer this question as your homework. Fine. Do let me know in the comment section that what is the answer of this particular question related to your with the first topic, that is the introduction. So introduction means we will be talking about all these topics briefly which are present in this particular chapter. Okay, we will be talking about what all terms are there. So fixed income market, simply stated, it means that you have already certain information regarding the income you will be having while investing in a particular market. In equity, what happens, you never know. If the market goes up, your profit will rise, but on the flip side, if it falls, then definitely you will be at loss. But nothing of that sort happens in the fixed income market. Who are the major market players here? Mostly you will find the discussion around government securities and the corporate bond. So the market comprises of these two big market players, the corporations as well as the government. And when we talk about government securities, whether they are not risky, so answer is no. The least risk which is involved in the entire market, entire financial market also, you can say, it is under the government securities. Now when it comes to the fixed income from the corporate bond market, whether this is highly risky? No. You can say that it is a bit risky as compared to the government securities, but overall the riskiness is nothing when we compare it with the equities. Fine. Next important thing, when you talk about the numerical aspect, or for that matter the formulas, so yes, this chapter will test you via some mathematical expressions. So mathematical expressions means what? We will be talking about the bond valuation. We will be talking about the bond theorems, how you will be arriving at a particular price of the bond, whether the fluctuation is happening or not. Based on that, based on the tenure, based on the coupon rate, how the ultimate calculation of the bond will look like, that will be determined by the bond valuation, the mathematical expression. And according to which theorems, or for that matter, which theorems are backing that particular expression, the mathematical expression, that is under the bond theorems topic. Next comes the extension of government securities. You know that government will be floating some securities known as G-Secs, or for that matter government securities. But how? What is the procedure? So for that, one auction will be conducted on regular basis by the RBI, but at which platform? Whether on the RBI's website only, the rbi.org.in, or is there a separate platform altogether? We will be looking into the auction of government securities.
Then comes a very pertinent question that who all constitute the primary dealers. Right? Primary dealership, you must have till now heard this term of primary dealers in every chapter, be it unit number 29, unit number 30 or 31. And if you have not read the topic of primary dealer on your own, you must be having certain inhibitions, certain confusion in your mind that whether primary dealers are the individuals or for that matter they are a setup which is being organized as an entity. So we'll be answering that also. Who are the primary dealers? Basically the enablers of your government securities market. Next comes one important association. Now this association, why it is important? Because in this fixed income market, you will find only a single reference of one market only, one association only, that is FIMDA, Fixed Income Money Market and Derivatives of India. Although it is SRO, but again very important when it comes to the role it performs in the fixed income market. The roles of your FIMDA, they form the essential part of the entire discussion around this particular organization. Then we have again the further discussion of auction for your government securities under the RBI Retail Direct Scheme or the RDS. Whether RBI will be having only one type of option on the RBI Retail Direct website, or you can do multiple auctions, or for that matter multiple operations can be performed on this particular website. Everything will be looking into this particular topic. Last is your ICDs, the intercorporate deposits, again an extension of your corporate bond markets. For our examination, what is the most important point? The most important point will be your bond valuation and the theorems along with the government securities. Government securities being the auction of the government securities, or for that matter your RBI Retail Direct Scheme via which the government securities are traded. Fine. Okay. So now let's move on to the discussion of the same. Fine. Let's try to have the discussion of each and every topic. Starting off with the basic introduction, that what is a fixed income market. Let me just scroll down a bit so that all of you can ask the question also. Okay, keep on asking any doubts if you have, fine, pertaining to this particular introduction, or for that matter the intro which we will be looking into the next slide. Fine. So when we talk about the definition of fixed income market, when we are saying that it is commonly known as debt or bond market, we simply mean to say that no kind of speculation is there. Fine. It is devoid of any speculation. So these markets are financial arenas where debt securities are issued and traded, allowing the governments as well as the corporations to raise the capital by borrowing from the investors. Fine. You are borrowing from the investors and ultimately raising the capital for your needs. Government can have n number of needs. Fine. Let's suppose the fiscal deficit is too high in our country. Government can float in the government securities, or for that matter certain corporations, they feel that they want funding for new projects, some expansion is ongoing in their corporation. For that also they can float the bond under the corporate bond market. What are the instruments? It includes government securities, corporate bonds, municipal bonds, treasury bill, or for that matter commercial paper. Commercial paper as well as the CDs we have discussed, fine, in the unit number 30th. So if you are not aware of the primary features or the basic features of the CDs, or for that matter your commercial papers, do go and watch the unit number 30th discussion after this video is over. Next comes the returns. The investors, they receive regular interest payments which is known as the coupons, and the return of the face value. So what is the face value? The value at which the bond is being presented to you. Fine. Ultimately, what is happening? You are earning certain interest payments, fine, earning via certain interest payments at regular intervals. And when you have the interest payments, do you think so that only that will be the amount which you have benefited out of this particular investment? Answer is no. Apart from that, you will also be having the principal amount, or for that matter, your face value in your account once the maturity arises. Next, we have the risk profile. So definitely they are much more safer as compared to the equity markets, providing lower but more predictable returns. The returns are much more predictable as compared to your equity market. Okay, now let's start our discussion with the government securities. So who will be floating the government securities? These will be floated by the state government, or for that matter central government. Only two big players are involved here. It includes central government securities, treasury bills, as well as the state government securities, commonly known as the SDL, state development loans. Also, when we talk about the purpose, what is the purpose? Right now you must be having a fresh idea, because the union budget was presented on 1st of Feb. Only 9 days have passed. So you must be having a fair idea that what is fiscal deficit. Fine. Normally we say that in common parlance, when the revenue of the government falls behind its expenditure, we are staring in a situation known as fiscal deficit. And in order to have the finance to overcome this gap between the revenue and expenditure, government often floats the government securities in the market. So they are issued in order to finance the fiscal deficit and managing the temporary cash mismatches of the government. Temporary cash mismatches, not the long term, for short term only. Now comes a part where you must be knowing that there are certain players who are eligible to participate in the purchase of these government securities. So government securities, who all can purchase? Mostly everybody. Mostly, the word is mostly. Be it the banks, financial institutions, the primary dealers. Who are the primary dealers? We'll be looking into that. But for now, just for 15-20 minutes, think of primary dealers as the entities who are the enablers of your securities market, which are floated as government securities. Fine. Then firms also can purchase the government securities, companies, corporate bodies, your partnership firm, institutions, mutual funds. You have the FIIs also, foreign institutional investors. A specific description of FIIs has been given in our economic survey, that because of the unfair trade practices right now ongoing in the global trade, FIIs are leaving our country. So they are also one of the purchasers of our government securities. Then we have state governments, provident funds, trusts, research organizations, and your NRB. NRB is what? Nepal Rashtra Bank, along with the individuals whosoever want to invest in the government security. So all these are the players who can purchase the government securities. Now, how the government securities are traded? Fine. Now we know that who can float the government securities? Central or the state government. Who can purchase the government securities? These are the entities. Now how they will be doing this buying or selling? Via a platform which is provided by the banks through RBI. So we have the government securities generally held by the banks and the institutions with the RBI in subsidiary journal ledger account, the SGL account. You must be knowing, in the banks there is one SGL account, the subsidiary journal ledger account. Here you will be having the government securities. They can be held in special accounts known as the CSGL, constituent subsidiary journal ledger, which can be opened with banks as well as primary dealers. Primary dealers are nothing but the banks only. Fine. NBFCs, some NBFCs, and mostly the banks. Or in demat form, which is being maintained by the depository participants of NSDL. So whenever you have the accounts being opened with bank or primary dealers, under which account you will be opening that? CSGL. And whenever the demat account is being opened, it will be maintained by the National Securities Depository Limited. So two options are there with the participants. These are the participants who want to trade in the government securities. They can either go via the banks and the PDs, or for that matter open the demat account. Banks, PDs, they maintain the accounts via CSGL, and the demat accounts directly, who will be maintaining? Your NSDL. Now comes the question that the government securities will be traded, everybody knows, but how? Fine. How? We will be looking into the income. This chapter talks about one fixed income, na? So how this fixed income arises? How you will be able to understand that whether a particular government security will be paying you X amount or Y amount. Let's talk about a simple calculation. So the government securities are issued normally at a par value, fine, and it is in the denomination of 100. Whenever we calculate the interest payment on a particular government security, it will be in line with the amount of rupees 100 and have a coupon rate, which is simply the interest rate, fine, the rate of interest which you will be earning as the purchaser of the government security, and it is decided at the time of issue by auction technique. Where is auction happening? It is happening simply at your RBI direct retail. These securities pay interest at coupon rate on the half yearly basis and are redeemed at par value on maturity. So you are earning two things. First, the par value of the bond when the particular security matures, fine, after the maturity. Over the top of it, in single year, twice you will be earning the interest, I1, I2. So half yearly basis, you can say that interest will be earned by the participants. What is the example? Because ultimately when we see, look or observe the examples, we learn in a much better manner. So let's suppose there is a bond like 7.99% GOI 2027. So GOI represents what? This particular bond market. In this particular situation, GOI represents what? The bond market being governed by the government securities we are talking about. So it is issued. How you will be reading this particular phrase? 7.99 will be what? It is the coupon rate. 7.99% is the coupon rate, and for every 100 worth of bonds you hold, you would receive 7.99 in interest per year, fine, per year. But when we talk about the regular payments, they will be split into two halves, because here it is written half yearly basis. So split into two payments of approximately 3.995 every 6 months. Okay, let me just give you the calculation here also. So this is what? 7.99%. It is the coupon rate, and it is being calculated at par value with respect to rupees 100. So 7.99% for every 100 rupee. 7.99%, you can write it like this: 7.99 divided by 100. Every 100 means what? You have to multiply this coupon rate with 100. These hundreds, they will get cancelled, and we have 7.99 as the annual earning per 100 rupees. But when we talk about the coupon rate, it is for the half yearly term, and the half yearly means what? You will be dividing this interest earning into two halves, and ultimately for per 6 months you will earn how much? This amount, 3.995 rupees per 6 months. Okay, fine. So that's how you calculate. And when you talk about the bond theorem, the bond valuation, we'll be covering that in detail in our paid classes. But yes, this is how the government securities work. Now comes the platform where you will be trading the government securities. Here you can see the screenshot from the Reserve Bank of India Retail Direct, and more or less you will find that the first step will be to open the RBI Retail Direct account. From this account only you will be participating in the fixed income market, specifically for the government securities. Fine. So step 1 will be open the RBI Retail Direct account from the website. Website is what? RBI Retail Direct. So this is a scheme providing one-stop solution to facilitate investment in government securities by individual investors, which has been issued. Highlights are, first of all, the retail investors or the individuals as we call them, they will have the facility to open and maintain the Retail Direct Gilt account, the RDG account with RBI. Once this is opened via the online portal, this is the online portal, you will be having the various facilities. The first one will be you can have the access to the primary issuance of your government securities, which is why you are enrolling via this particular scheme. And the second one, in the secondary market also, the NDS OM we have seen in the secondary market chapter, that also you can access via the RBI Retail Direct platform. Okay, so both things, both tasks you can do via this particular website. Next is, what is the procedure for registration? So simply stated, there will be certain documents, there will be certain important procedure involved. So first of all, what all you require to open this Retail Direct Gilt account? You must have a mobile number linked to your Aadhaar, active saving bank account with the net bank as well as UPI facility. That is the primary, you can say, requirement. Signature image of the account holder, fine, the signature must be present. Original PAN, in case we are talking about the video KYC, you must have the original PAN card with you. Also the bank account number as well as IFSC code. But when it comes to the address change, fine, supposingly the address has changed in this particular bank account, the active saving bank account, then what you have to give, the proof of your address change must also be there. Now apart from that, there are certain other conditions. For Aadhaar based KYC, you have to complete the video identification within 3 days, and you have to enable the pop-ups on your PC or mobile, because n number of pop-ups will be there once you will be registering in the RBI Retail Direct. Allowable file formats are JPG, JPEG, PNG, PDF, and the maximum file size will be 5 MB. A very important point when it comes to the registration under your RBI Retail Direct scheme. Now comes the part that how the investors will be receiving the information, whatever they have registered for. So investors can register on the online portal by filling up the form and use the OTP received on the registered mobile number as well as email ID to authenticate and submit this particular form. You will be clicking here, open the RBI Retail Direct account. One page will open, and there you will be filling all the necessary details, and you will receive the OTP on your mobile number as well as on the mail ID. Instructions issued under the RBI KYC Direction 2016, updated from time to time, will be adhered to during onboarding the investors. While you are trying to register on the website of RBI to open the Retail Direct Gilt account, you must go through the RBI KYC guidelines 2016, because ultimately all these points are mentioned in that particular guideline itself. Once you are registered, you have successfully registered, the Retail Direct Gilt account will be opened. You will have the RDG number, right? Retail Direct Gilt account number, and details for accessing the online portal will be conveyed through SMS or email. Fine. Then you will do what? Go to login and just enter the details, the login credentials. RDG account shall be available for primary market participation, as we call it, and the secondary market transaction on the NDS OM. Fine. So both the processes you can access once you register under the RBI Retail Direct. Fine. Here it is mentioned also, login to RBI Retail Direct account, or for that matter in the secondary market we have the NDS OM as well, the second option. Fine. Till here, any doubt, any kind of doubt you have? Let me just see. Okay, no doubts. Fine, fine. See, keep on asking whatever doubts you are facing right now, because ultimately then only you will be able to understand the topic in a much better manner. Fine. Now comes the point that what is primary dealer? Simply stated, primary dealers, as I was telling also, that they are just the enablers. Fine. They are here to promote the transactions in government securities market. Fine. So the promotion of the transaction in your G-Secs will be done by the primary dealers, and these are what? These are the entities registered with RBI. That is the first important thing which you must understand, that the entities whosoever wishes to act as a primary dealer, it must register with RBI. Why? Because ultimately RBI will provide the license to purchase and sell the government securities. Fine. These are the entities who buy the securities from the RBI, aiming to resell them to other buyers. There will be other buyers also. Fine. The purchasers which we have seen. Then in this way the primary dealers create a market. Fine. They are creating a market for your government securities. Plus, when we talk about the genesis of this particular type of setup, the primary dealers, whether it was there since independence, answer is no. It was started by the RBI or introduced by RBI in 1995 only. Next comes the important aspect, that who all are the primary dealers. Let's go through the examples first, then we will be looking into the remaining topics. So the two lists which you can access here, the first one being standalone primary dealers who are here registered as NBFCs. These are simply the NBFCs who are operating as the primary dealers. Second one, the bank primary dealers. They are providing the functions or fulfilling the functions of being a bank, as well as they are providing the option for being a primary dealer. Fine. They are performing both the functions. So the standalone PDs, what all are there? So we have a list which includes ICICI Securities, Morgan Stanley, Nomura Fixed Income Securities, PNB Gilts, SBI DFHI, STCI primary dealer. Then we have the Goldman Sachs as well. All these are very, very important. Next comes the bank primary dealer. So you can see mostly you must have heard the name of these banks, like Bank of America, Bank of Baroda, Canara Bank. You have the Union Bank of India also, HDFC Bank. So one thing is for sure, not only the foreign banks, not only the public sector banks, but also the private banks are a part of your bank primary dealer setup. Citibank, HSBC, JP Morgan Chase Bank, Kotak Mahindra, you have the Standard Chartered, then Axis Bank, IDBI, Deutsche Bank, as well as Yes Bank. So all these are what? They form the part of your ecosystem known as primary dealers. Right? Okay. So I hope that now you understand for sure that who all are the primary dealers. Now moving back to the arrangement, how the primary dealers function. So a facilitating arrangement is essential for selling of the government securities, as government is the single largest borrower in the market, which borrows through the issue of its securities, that is your treasury bills and the bonds. And this facilitating arrangement will be provided by whom? It will be provided by the primary dealers. RBI, it stipulates various guidelines when it comes to the operational aspect of primary dealers. It can state that yes, this must be the minimum turnover ratio, minimum bidding ratio, minimum underwriting ratio. Why? Because ultimately the PDs are what? They are the underwriters. They are preparing the government securities for transaction in the securities market. In order to ensure that they are active in supporting the trade in government securities. Fine. So very important aspect of primary dealers, that they provide what? A facilitating arrangement so as to have the government securities traded in the market. Now comes the eligibility conditions. We have seen the names, fine, the types, standalone and your bank. But when it comes to the eligibility condition, what are those? First of all, the first condition states subsidiary of the scheduled commercial banks or the all India financial institutions can be a part of your primary dealer ecosystem. There is no you can say exception to that. Subsidiaries of your scheduled commercial banks can also be the primary dealers. Then subsidiaries or the joint ventures who are set up in India by the entities incorporated abroad. Fine. So when we talk about the Bank of America, then we have the Citibank, HSBC, all these are what? The entities which are being incorporated abroad. Then the company incorporated under the Companies Act and does not fall under these two, A or B. Still, that particular company can be a primary dealer. The applicant for PD should register as the NBFC for at least 1 year prior to the submission of its application for the primary dealer. So always remember, whosoever the applicant is, fine, whosoever is the applicant for your primary dealership, they must be at least for 1 year registered as NBFC. And who will be taking care of this registration? RBI. The decision to authorize PD is taken by RBI based on its perception of market needs, suitability of the applicant and the likely value addition of the to the system. So when we talk about the suitability, the market trend, whether it follows with the primary dealer operations or not, whether we need to expand this entire ecosystem of primary dealers or not, based on this market research, RBI will give a heads up to new or for that matter fresh PDs. Fine. Now comes the numbers. When you talk about the numbers in case of primary dealers, first and the foremost point, the data is updated till 2024. Fine. After that, nothing has changed much in the primary dealers. So we have 21 primary dealers, out of which 14 they function as bank primary dealers. Fine. They have a separate department, and 7 will be the standalone PDs registered as NBFCs under the section 45 IA of the RBI Act 1934. A very important point, that they are registered under which particular act? RBI Act 1934. Registered as what? Registered as NBFC. Under which section? Section 45 IA. Next comes the distinguishing factor between the SPD and your BPDs. So standalone primary dealers and bank primary dealers, the most important point of difference is the standalone PDs, they are being registered as NBFCs, and the bank PDs, they do not have such kind of setup. So SPDs are registered with RBI as NBFCs. They can be the subsidiaries of scheduled commercial banks, Indian subsidiaries of foreign entities, or companies which are incorporated under the Companies Act. All these are a part of your eligibility criteria when it comes to the SPDs. They also focus on trading government securities and the related activities. That is what the primary dealers do, right? Examples being ICICI Securities, Morgan Stanley, Nomura Fixed Income Securities and others. Then we have the important primary dealer classification as the bank primary dealers. Here you will find that all those banks which have been authorized by the RBI, they can act as a primary dealer. So these are the banks that have been authorized by RBI to undertake the primary dealership activities as a department within their operations. Right? So banks, they are performing various functions. Over the top of it, they can also participate as primary dealer. They don't have a separate subsidiary undertaking the PD business. Fine. So primary dealership business, more or less, they are directly integrating this particular business with the various departments they have for different roles. Example, Bank of America, Bank of Baroda as well as Canara Bank. Okay. So now I hope that primary dealers are clear to everybody. fine, because if you don't know about the primary dealers, you won't be able to make sense of all the topics where the primary dealers are mentioned, fine. Now, before moving on to the FIMDA, let's try to have a discussion, a brief discussion about the corporate bond market. Government securities we have seen floated by the government. What about the corporate bond market? Who governs this type of market? So simply stated, these are the debt securities issued by companies which are here to raise capital for the expansion for their certain operations or refinancing the debt. When you talk about the holders or the investors, whosoever will be investing in this particular bond market, they will be receiving regular interest payments which is known as coupon, and the principal amount at the maturity, fine. So more or less the setup is same, but the players will differ. Who will be issuing these securities? These bonds will be issued by the companies. And what type of companies? Here is the elaborate list. Overall, this market in India comprises bonds issued by various corporations for their normal business activities. What all activities are there? We will be looking into that. But when it comes to the players which are involved, they can be public sector enterprises. The most common, everybody must be knowing, NTPC is also there. Then we have public sector banks for augmenting the additional tier 1, tier 2 capital. What is tier 1? What is tier 2 capital? We will be taking up a separate session for this as well. So we have SBI, PNB, Bank of Baroda, so on. All the public sector banks are listed. Then we have the private sector banks. Again, why they are floating the corporate bonds in the market? So as to augment their capital, tier 1 and tier 2. For AIFIs, All India Financial Institutions, you will find IDFC, NABARD, Exim Bank. They also float these bonds in the market so as to have some additional capital. Then we have the private sector companies, the Tata Motors Limited, Reliance Industries, Hindalco, Grasim, Tata Tea. All these are what? The private sector companies who will be participating or floating the bonds in the corporate bond market. Along with that, HFCs, a very, very important point. Often candidates, they ignore this classification, and when in the examination the same classification is asked, they get confused. So always remember, the facts are very, very important for your IE and IFS, specifically for this particular chapter. So HFCs, be it the HDFC, LIC Housing Finance, PNB Housing Finance, HUDCO, all these are what? They form the part of corporate bond market. They basically float the bonds which will be purchased by the investors. NBFCs, we have Mahindra and Mahindra Finance, Tata Motors, Citicorp, Sundaram Finance. Then we have Chola Mandalam Finance, Bajaj Auto Limited. All these are what? Under the part of your corporate bond market. State level undertakings, we have state level power generation corporations, fine. So whosoever is involved in the power generation, like DHBVN is there in Haryana. Then we have state level power transmission corporation. Power transmission and power generation, different corporations are there. State level power finance corporations are also there. Then we have the state level infrastructure development finance corporations, commonly known as your IDFCs, state level IDFCs. State level electricity boards, state level road transport corporation, state level development corporations, state level industrial development boards, state level municipal bodies. All these are what? Under the state level undertakings, and they also participate in the corporate bond market. Then we have certain institutional participants also, such as banks, primary dealers, mutual funds, insurance companies also. The retirement funds, corporates, all these will be the major players of your corporate bond market. Right? Insurance companies are also involved. After that, you must be knowing that whenever we are discussing the fixed bond market, we say that government security is not at all risky. But what about the corporate bond market? Here, the riskiness will be determined via various ratings. So the corporate bonds, they are priced at a spread over the corresponding government security depending on the level of perceived risk. Whatever the risk is involved, the rating agencies will be determining that and providing the ratings. This is because these bonds are not sovereign bonds, not governed by any government directly, and are serviced by the entities who are issuing them and carry a risk of default. These corporations, do you have the guarantee that none of them will go in loss, or for that matter they will be always profitable? No. So risk of default is there on the part of entity in fulfilling the interest or principal payment obligations. Fine. So that is the reason why we say that yes, risk is involved in the corporate bond market. Not that high as compared to the equity market, but yes, as compared to the government securities, it is risky. Corporate bonds usually carry a rating, normally triple A. See, all the major rating agencies, they will give the highest rating, the least risky rating as triple A to D. Fine. The chances of defaulting are very high. Then you will get the rating as D, as specified by the rating agencies, depending on the variety of fundamental factors pertaining to the company issuing the bonds. Fine. So the company whosoever is issuing the bond, these rating agencies, Moody's, Standards and Poor's, your Fitch rating agency, they will be judging based on that and ultimately coming up with the ratings for the individuals, or for that matter entities whosoever are participating in the corporate bond market, so that they can have an informed decision. Okay. Next we have that the ratings, they simply indicate what? The level of risk of default on the issuer, with AAA indicating highest safety. These are what? These are highest safety, and D indicating very high probability of default. Here lies the red zone. Fine. Red zone you can call it, the default zone. And in between you will find various nomenclature is there. More or less they will be having some commonality, the most of the rating agencies, but let's just see the Moody's, which is the most important, or for that matter the most common one. So in case of Moody's, let me just erase. Okay, let's just see it like this only. So when you talk about Moody's, AAA means what? The least risky one. Then we have AA, more risky. A, much more risky as compared to AAA. Then we have triple B. This is what? This is the investment grade. Investment grade means what? That till here you can invest. Fine. That is the suggestion from the rating agency. The bonds up to the rating of triple B are categorized as investment grade. But after that, double B, B, triple C, double C, C or D, they are highly risky as per most of the rating agencies. So rating on the bonds is reviewed by rating agencies on regular basis, periodic basis. All the bonds are issued and held in dematerialized form. Fine. Again, the demat form will be there since 2002 as per the RBI regulations. What are the central depositories involved here in this particular rating? There are two central depositories for all the bonds, NSDL as well as CDSL, which we have discussed in the initial remarks of this chapter, where the bonds are held in electronic form. Banks will be taking in which particular form? The account will be opened for a specific ledger name. What is the name of that particular account? Do let me know in the comment section. We have covered this. And when it comes to the demat form, we have the NSDL, the depository who will be taking care of the bond market. With the brief introduction of the entire chapter, which is named as foreign exchange markets. Now, these forex markets, why they are important for us in this global network oriented era? Because you are doing what? Simply stated, if you are involved in trade activities, then you have two options. One, you can go via the domestic market. Fine. One is your what? Domestic market. You will be producing some goods, some commodities and selling them in the domestic arena. Second point, which is much more important, much more relevant for the exporters, is that we must have a free will in order to export our products. The production which you are doing domestically, either you will be doing what? You will be selling that product within the nation, within the country, that is the domestic selling will be there, or you want to have a certain commodity exported, then you have the forex market open for you for all the transactions you need to do. Now this is a broader forum via which we can understand that what directly is the benefit of foreign exchange market. But is it only about the trade? Answer is no. A very simple example, when you visit, let's suppose Japan, fine, you are on a vacation with your family visiting Japan, and there you will be utilizing the funds which you have in your bank account. Now before moving, or for that matter while planning your Japan visit, what you will be doing? You will think about changing the currency, exchanging the currency, and that particular activity also, this transaction, simplistic transaction, is also under your forex market. You are able to transact freely, you are able to exchange the currency very easily nowadays in our country. Why? Because the market is free. Indian market is now free, devoid of any strict rules, at least for day-to-day transactions. Fine. What is the specific meaning for day-to-day transaction? We'll be looking into that also. Fine. So yes, forex market, very important. All these aspects, the definition, introduction, we'll be looking into the profile of forex market. Then comes the evolution of forex market. So whether this market was open since the beginning in our country or not, that we will be looking into the second topic, that is the evolution, how it evolved, what were the rules undertaken by the RBI earlier and presently where we stand. Then we have the characteristics of forex market. If you want to have any transaction accomplished via the forex market, you must know what are the traits of this particular market, whether it is highly liquid or not, whether you can easily convert the currency or not, or for that matter whether this market is open 24/7 or not, because we have seen in the stock market there is a stipulated trading time period on daily basis, whether such stipulation is there in the forex market, or do we have a 24/7 market. Next we have the market participants. Who all will be the market participants? Simply stated, it starts with the party who wants to transact into the foreign exchange market, fine, the first and the foremost. Then via one broker they will be doing this transaction. It is not like which we do in the stock exchanges where the exchange is directly involved. No, we will be doing the forex transaction a particular broker. Then third important part will be the regulator, and the regulator will be your RBI. The primary regulator will be RBI, and when it comes to the various security market transactions, then SEBI can also be involved. So all these will be looking into the market participants, and need not to forget the most important market participant who will be determining whether the trade activities you are doing within the country or abroad will be regulated with higher interest or the higher tariff rate, or there will be a rebate in the tariff rate, that is your government. So government will also be one of the participant. So these four initial pointers which we have discussed, more or less questions will be asked from here also. Often we ignore in IE and IFS that there is no need to cover the introductory part of these chapters, especially in module D. Do not make that mistake, because on regular basis 1 to 2 marker questions you can expect from these four topics. After that we will be having some specific discussion. These were what? The generic discussion. In between you will find some specific topics like the evolution, but overall it is just an introductory part of your forex market. Then comes the specific terms which are utilized in the forex market, starting off with the reference rates. What do we mean by LIBOR? what is the ARR, that is your alternate reference rate. Over the top of that, whether we have a dedicated platform where the retail market under the forex will be traded. So FX retail platform we will be studying. Then which legislation in our country is determining the overall forex market transaction? It is the Foreign Exchange Management Act. So all these topics are also very, very important. Then comes the depository receipt, which are mainly of two types, because America is a pioneer when it comes to the forex market. So we must know what are the American depository receipt and the journal or the global depository receipts. In between you will find some topics which are not that important, but yes, we must be doing them as well, because you never know from where IIBF will ask the question. FEDI also, you can say that more or less this is the Forex Dealer Association of our country. So what are the characteristics of this association? That is also very, very important. Fine. So today we will be talking about the starting point, that is your definition and introduction of forex market. We will be starting from here. So what is the forex market? Simply stated, it comprises of a set of transactions among forex market participants. Fine. Various participants are there. As I just told you, there will be individuals who want to transact globally, and via the brokers they will be doing that. So three primary participants will be these. Then we will be having regulator as well as the government. So they are involved in exchange of specified sum of money in a currency unit of any given nation for the currency of another nation at an agreed rate as on any specified date. So the main point or the highlight will be the specific date which is involved while transacting in a forex market. There will be mostly two parties, not like what happens in the stock exchanges. You will be doing these transactions how? Via the OTC, over the counter transactions. Fine. One individual will approach the broker and the broker will provide the finalization to the transaction via the third entity. During the exchange rate of one currency, supposingly the INR we are talking about, to another currency is determined simply by the demand and supply, the exchange to which both parties agree. Now you must be knowing that the numbers of our INR has been, they are definitely right now also plummeting, and more or less rupees 90 is somewhat the approximate exchange value with respect to dollar. Reason being the overall availability as well as the demand of INR is not there in the market, and that is the reason why we say that studying the forex market will not only tell us about the global scenario but also how the other countries perceive our nation. So the forex market, it is composed of major internationally traded currencies, like we have the US dollar, you have the euro, the pound sterling, Japanese yen, and lesser traded regional currencies also like Canadian dollar, Australian dollar, Swiss franc, as well as INR also. So more or less when we talk about the forex market, you must be very much sure that how the things are going on. The first and the foremost point is that it is not at all related to the things which are there in the stock market. In the stock market, exchange is involved. Here most of the transaction in forex you will see in the OTC mode. So this is an interbank market that took shape in 1971 when the global trade shifted from fixed exchange rate to floating one. So what is this fixed exchange rate and what do we mean by the floating exchange rate? Simply stated, fixed exchange rate is what? A particular exchange rate which will be predetermined. Predetermined by whom? By either the government or, for that matter, central bank of the country. In case of floating exchange rate, what happens? It is determined by the supply and demand. That is, the market forces will be at play while determining the final number of a particular currency. Fine. So yes, supply and demand, and since the demand is not high right now in the market of INR, it is going down as compared to the US dollar. So when you talk about the stability aspect of fixed exchange rate, which is determined by the government or the central bank, the stability, so it provides predictable rates for the trade, more or less stable you can say. But floating exchange rate, it produces the fluctuations in the market. So rates fluctuate constantly based on the market news. What is the example for your fixed exchange rate? So country pegging its currency exactly to US dollar. Fine. 1 US dollar is equal to 1 denomination of our currency, our country's currency. That is the fixed rate we are talking about. But whenever we talk about the floating exchange rate, more or less, if more people they want to buy Indian good, the demand of INR will rise, making the rupee stronger as against to the dollar. Fine. So yes, that is the reason why we keep on saying that fluctuation is happening in the INR. And right now, as I was just telling you, the demand of our currency is not that much high. By demand of currency, what do we mean? The commodities which we are producing, they are not at all in demand as compared to some other currencies. Fine. So fixed versus floating exchange rate, I hope that now you are able to understand that what is the primary difference. The primary difference is the more you you can say provide a free network of exchange rates, the more you are inclined towards the floating one, and if you try to regulate the exchange rate, it is termed as the fixed exchange rate. Now coming back to the point that the forex market is an interbank market. Fine. Interbank market that took shape in 1971. Prior to 1971, the forex market was not officially in the global network. When the global trade shifted from fixed to floating ones, right, the countries will be much more interested in doing trade with your country when there is no restriction whatsoever for the amount which is involved in the transaction. The convertibility should be free. The currency must be freely convertible. What do we mean by the freely convertible currency, or for that matter current versus capital account transaction? That also we'll be learning in this particular session. Now comes a point where we try to define that what exactly is written in the FEMA 1999 rules when we say that foreign exchange is having a particular definition, right? Just now we have seen that we have a definition of forex, that is all the interbank transactions, fine, interbank transactions, and that too in the floating exchange rate. Fine, that is the basic one. But what is written in the FEMA 1999 rules? Let's see one by one. So these definition, or for that matter the culmination of these pointers which will be providing us the definition of foreign exchange, it is mentioned in the section 2 clause N of FEMA 1999. So when we talk about the foreign currency, foreign exchange means simply the foreign currency, and it also includes various points. First point, the foreign currency including the deposit, credit, balance payable in any foreign currency. You want to pay to a trader some amount, fine, you are the exporter from India, you want to pay XYZ amount to a particular trader. How you can do that? Utilizing the forex mechanism. So you are providing the credit in the account of the trader who is sitting in, let's suppose, China. We have good relations with China. Then we have drafts, traveler checks, letter of credit, bill of exchange expressed or drawn in Indian currency but payable in any foreign currency. Fine. So you want to do what? Being an Indian, you are, let's suppose, going abroad, or for that matter you are studying abroad itself, or vice versa. Somebody from, let's suppose, Scotland comes to our country and they want to exchange the money in the form of what? LC we have, fine, LC, the non-fund based facility. Then traveler's check, there can be draft for that also, which are drawn in our currency but payable in the foreign currency. The bill is in INR and we want to convert it to any foreign currency. Supposingly we want to pay some dues to the other country. Then also the transaction is having the domain of forex. Then we have drafts, traveler check, LCs, bills of exchange drawn by banks, institutions or persons outside India. Fine. The second example of Scotland, but payable in INR, Indian currency. Okay. So yes, whenever we say that the forex market is there, we do not only mean that simple transactions are happening, but also some of the non-fund based facilities are also in the purview of this particular definition. Now comes the market structure. What is the market structure of forex and what about the characteristics of this particular market? As I told you in the beginning itself that this particular forex market is global market and works under the OTC network, over the counter. Fine. It is not like your exchanges. Fine. In the exchange you will be having one stipulated rule for a particular transaction. You have to list your particular transaction on the exchange. But here in the forex market you have to do what? You supposingly are the buyer. Fine. Supposingly you are the buyer here and you have a particular seller also, fine, for a particular transaction. So the OTC market, since it does not have any kind of physical location, you will be having one setup where the intermediary will be a broker or a dealer. So the buyer will be doing what? Whether the buyer can directly communicate with the seller? Answer is yes. No harm at all. Electronic means are present. Fine. Nobody is telling you that no, you cannot go with this particular process flow. You can, but normally we have an intermediary in the form of broker or the dealer. So normally the buyer will do what? Communicate to initiate a trade to your broker, to the broker, and the broker will be trading via the brokers trading platform. Now various brokers trading platform also will be learning in this particular chapter only, but for now let's just say that this is a platform via which the brokers can deal with the seller. Okay. And why this particular setup is present in the forex market? Because mostly, let's suppose for 100 US dollar transaction, the buyer has to pay only $1. There is some ratio which is involved, the number of transactions which are involved in line with the amount present with the buyer, and normally the buyer has lesser amount with them, and the remaining amount will be settled via the broker itself. But you must be feeling that for 100 US dollar transaction I have to pay only $1 US. So it's a win-win situation for the buyer, but it will turn into a negative scenario for the buyer in case the market turns against the buyer, in case there is loss. Then already you have only $1. How you will be compensating the broker with 99? Fine. So yes, both ways it works, but when we talk about the forex market structure, normally you will find this particular process flow. So buyer communicating to initiate a trade to the broker, and the broker will be trading via the brokers trading platform. And when we talk about the buyer, he or she will be providing the same communication to initiate the trade with the seller as well. Fine. So when we talk about the brokers, you can say the broker's role will be to provide a dedicated platform so that in the forex market both the buyer as well as seller can trade. Simply stated, it is not that complicated as compared to the exchanges. Now comes the theory part. The forex market, it is global decentralized environment where currencies are traded, and currencies will be traded for what? Some services. You are providing some service to a person, then only they will be providing you with the money. Fine. So the currencies will be traded because you are providing some services. Over the counter market will be present in the forex market. Unlike the stock exchanges with a central physical location, most of the forex trading will happen in the over the counter. This means trades occur directly between two parties, like two banks can be there via electronic networks. For example, when I talk about Indian bank buying the euros directly from a German bank, this is also what? A forex transaction involving two currencies through a digital trading platform rather than on a centralized floor. Fine. Without going for any listing or going to the stock exchanges, you are doing what? You are just contacting the German bank to buy the euro from that particular bank. The two entities, buyer will be what? The Indian bank, let's suppose SBI, and your seller will be that German bank. Next comes the important characteristic of 24-hour global operation. Now, when we talk about the stock exchanges, the trading time is set, fine, that by 3 p.m. You have to close the trade. But here in the forex, the market follows the sun across the time zones, spanning 19 hours from New Zealand to USA. So more or less you can say 24-hour global operation is there. When we talk about the time zones, you will find that when the market will open in New Zealand, fine, when the market will open in New Zealand during that time, fine, supposingly 9 a.m. is the time, then in USA, supposingly we have a specific location in the USA, we will be witnessing what? The previous day. Today is what? Supposingly we are right now starting our day. So today is what? Thursday. So if on Thursday there will be opening of forex market in New Zealand at, let's suppose, 9 a.m., then at this time in New Zealand, what will be the time in USA? We will be witnessing the previous day, that is Wednesday, and most probably the time will be 1 p.m. of the previous day. Fine. So once the market closes, let's suppose for USA, it is still operational in the New Zealand zone. So the sun never sets effect, that is the apt term which is utilized for the forex markets, because the market opens at 9 a.m. in Auckland, which is in New Zealand only. It is still 1 p.m. in the previous day in San Francisco, located in USA. So yes, one of the important characteristic is 24-hour global operation is ongoing. Second important part is the geographical advantage. In Sensex or stock exchanges, you don't get this geographical advantage, but in forex, yes, you will be having that. Locations like Bahrain can trade with Tokyo, which is in the east of Bahrain, fine, Japan, and New York, that is in the west, on the same day due to their central position, fine. So Western Asian countries, they are here, Bahrain being one of them. Now to the east of Bahrain will be your Japan or Tokyo, as is written here, and to the right of this particular country, let's suppose Bahrain only, we have the New York. So on the same day, the Western Asian countries or specifically Bahrain can trade with both Tokyo as well as New York, because it depends upon your time zone. There are specific time zones across which the forex market operates, right? So yes, that is also one of the important characteristic not shown by the stock exchanges, but in forex market it is fairly common. Then comes the evolution of forex market in our country. So whenever there is a question in the examination related to the evolution of XYZ market in our country, you will find one important question every time IIBF will be asking. It will be from the relevant committees, fine. So always remember what all important committees are there in every evolution of any of the market which is being discussed in the book, fine. So committee name, very important. Committee chairperson's name is also very important. So the Indian forex market, whether it was free from the day one or for that matter beginning, or earlier it was free, then some restrictions came, after that we had certain more you can say freely tradable ways so that to transact in the forex market. What exactly happened? Let's see one by one. So the Indian forex market, it owes its establishing to the important step that RBI took in 1978. Back in 78, RBI started this particular phenomena, that is the forex transactions in our country. How? By allowing the bank to undertake intraday trading in forex. Fine. So for a forex market or foreign exchange, the banks were allowed to do the intraday trading. Within the day, whatever the trade is going on, banks can participate. During the period of 75 to 92, the exchange rate of rupee was officially determined by RBI. So earlier RBI was determining the rate of your foreign exchange. In terms of the weighted basket of currencies of India's major trading partners, there was significant restrictions on the current account transactions. So one thing which you must remember, that till the economic reforms of 1991, there were n number of restrictions when we talk about the forex market for our country. And this particular forex market, it was opened only after the economic reforms, and the restrictions mainly they pertain to the current account transactions. Now what is this current account transaction? See, when we talk about the overall scenario in Indian market, you will find one important aspect, that there are two types of accounts. Fine. One is your current account. Second one is your capital account. Now this current account is what? Simply stated, all those day-to-day transactions, fine, day-to-day transactions which are ongoing across the globe are termed, or for that matter are categorized under the current account. What kind of day-to-day transaction? You are visiting again the vacation you are going on, that is Japan, and there you want to have the currency exchanged, or for that matter you are utilizing your forex card to make the payments in Tokyo. That is what? Day-to-day transaction. Then we have capital account. What is capital account? Long-term investment you are trying to do. Supposingly you want to buy one skyscraper in Dubai. Okay, so that is what? A long-term investment only. Overnight you cannot just buy it, na? Okay, so the investment, for investment purposes, you are buying a particular skyscraper. Fine. So that is what? That is a long-term transaction which will be categorized in the capital account. In India, right now when we talk about 2026, the current account convertibility is fully implemented. You can have the transaction on day-to-day basis, daily basis, whatever transactions you are doing in the forex market freely. There is no restriction whatsoever. Government won't ask you a single question. Fine. But when it comes to the capital market, or for that matter capital account, the transactions in the capital account, government will be asking the questions, and not only the questions, government will be very much serious, and it will also ask you that whether you want to have this investment on your particular account or not. The government will be laying down specific guidelines for you, and whether you are following those guidelines or not, government will be keeping a track record of that also. So yes, capital account convertibility is not fully implemented right now in our country, but current account convertibility, yes, fully implemented. Fine. So these are some terms which you must remember. Not, they won't be asking you in the examination, but yes, for understanding the forex market, such simple terms you must know. Fine. So there were significant restrictions on current account transactions, means the day-to-day transaction which people were doing in the forex market. Now comes the July 1991 reforms, that is your economic reforms. The initiation of economic reforms in July 1991 saw significant two-step downward adjustment in the exchange rate of the rupee on July 1st and July 3rd. Now what is this downward adjustment. Why RBI will be adjusting the rupee downward? Think about it. Think about it. So, with the initiation of your economic reforms, we saw a two-step, fine, two-step downward adjustment. So, whenever there is a currency with high value, fine, supposingly in India, one exporter is there and the value of the commodity is also high. And there is one particular trader sitting abroad, sitting, let's suppose in Washington DC, wants to buy that commodity from the trader in India. Now, whether that particular trader who is sitting in Washington DC, he or she would be happy to pay 200 rupees for that commodity or only 100 rupee. Just think about it. Being a trader, the primary focus is profit maximization, and how the trader will have the maximum profit when they approach the market with the mindset that I will be taking or picking the commodities from this market only when you sell me the cheap rate. Fine. In the cheap rate, they want every commodity. So once the traders are very much sure that yes, this is the best market price which I will be getting in India, then they will be more and more interested in buying the remaining commodities as well. Gradually, what you will find, the market of Indian commodities will rise. Why? Because of the lesser value of rupee. Right? The goods are now cheaper as compared to 1 year back. Okay, in the foreign market, I am telling you. So that was the reason why RBI did this two-step downward adjustment. Fine, more or less you can say that RBI was very much reluctant initially in the 70s, 80s, but in 90s the task in front of RBI was to have more and more money from the foreign exchange market also, which now we know as the forex reserve also. Fine. So the exchange rate of the rupee was downward adjusted, and it was done in two steps, once 1st July, then 3rd July, with a view to placing it at an appropriate level in line with the inflation differential to maintain the competitiveness of exports. Simply stated, the objective was to maintain the competitiveness. You sell cheaper, fine, you have lesser levies on your goods, the foreign market will be interested to buy the commodities from you. But what about this inflation differential? Inflation differential simply means the price which we were paying initially for making a particular commodity, it has been deliberately slashed by the RBI. Why? Because we want to sell it cheaper in the global market. Fine. So yes, the inflation will be more or less, the inflation is what? Sustained price rise. But when RBI deliberately brings it down so that the exporters will become much more competitive in the global market, then we see this inflation differential working, and it was utilized via two-step. Why two-step? Because first one was whether we will be able to implement it or not. Second step, RBI completely implemented it because it was a pilot project, India being a developing nation, and it was the first time that RBI wanted to open up the forex market, obviously in consultation with the government. So here is the explanation that why RBI did this. So when your currency is weaker, your goods become cheaper for people in other countries to buy. They will be having much more demand as compared to earlier levels. Before and after, let's just see by the example. Supposingly $1 is equal to 20 rupees, just for the sake of simplicity. A shirt costing 200 rupees, it will cost you in the US market or in dollars how much? It will be $10, fine, 200 rupees, $10. But once the currency is being deliberately adjusted downward by the RBI, then what will happen? If the rupee is devalued, so 1 rupee, let's suppose it $1, let's suppose it comes out to be 25 rupees. Fine. Earlier it was 20 rupees. Now it has been changed to 25 rupees. The level of Indian currency is now lower as compared to the US currency. The same 200 shirt now costs how much? Only $8. Simply 25 into your amount of 200. Right. So yes, when we talk about this mechanism, here you will find the difference will be what? US dollar to. This will be the saving for those buyers who are sitting abroad. So they will be having the benefit or profit of 2 rupees. And in general, you will find that this is just for one commodity and one item of that commodity. Overall, if you see the elaborate or the broader picture, Indian market will become competitive because you are producing goods at nominal rate. So the result will be Indian exports become more competitive, cheaper on the global market, helping India earn more foreign money. Fine. Now you can earn much more foreign money. Earlier when the rate was, let's suppose, $10 for one shirt, then the people who will be interested in this $10 shirt were, let's suppose, only 200. Now once the rates are slashed, more and more people will buy this commodity in the foreign market, and you will be able to sell 400 items, more than 400 items only. And when you multiply the two numbers, you will have much more US dollar incoming as compared to the earlier scenario. Fine. So yes, that is how RBI has gone through the devaluation of the currency, and the reason was to stay competitive in the forex. Now in 1991, India was running out of the foreign money. To fix this, government slashed the value of rupee to encourage the foreigners to buy more Indian goods and to bring the currency's official value closer to its actual economic worth. Fine. So you have two things. One, if the currency is not doing well, what you do? Devalue the currency, and you will find much more buyers, and the inflow of the US dollar will increase. Ultimately, the culminating effect, cumulative effect, will be much more higher as compared to the earlier scenario. Okay. Now comes the evolution of forex market related to the committees. Very important. Fine. The committees are very important. Although only two committees are there, Rangarajan committee is there, and then we also have one more committee, that is Sodhani committee. Fine. So both committees are very important. Let's start our discussion with the C. Rangarajan committee. So when we say that which committee is at the helm of forex market recommendations in case of India, then C. Rangarajan committee will find a special mention, because based on this committee's recommendation only, we saw huge drastic changes in the forex operations. So following the recommendations of high level committee on balance of payment, Chairman C. Rangarajan, the liberalized exchange rate management system, that is LERMS. And you must have heard LERMS. We will be learning about this also. But when we talk about the LERMS, it was just the first point, the initiation made by the recommendations of your Rangarajan committee. So liberalized exchange rate. Liberalized means what? No more centralization of the exchange rate. Let the market decide the exchange rate. Involving dual exchange rate mechanism was instituted in March 1992. March 1992, a very important time for the forex market in our country, which was followed by ultimate convergence of the dual rates effective from 1st March 93, also known as the modified LERMS. So why RBI initiated a dual operation here as well? Simply stated, the dual rate system was what? That since the Indian economy was closed from the day one itself, fine, only after the economic reforms we expanded in the forex market. So when a market is closed, you don't know what will be the response once you open it. Fine. So whenever there will be the opening of the market, you must be pretty much cautious. And that cautious step was made by the RBI also, that initially let's just try to open the market for some particular you can say transactions. Let's go with the 40-60% rule, and once the response is good and the market itself is running the transactions, then we can expand, then we can liberate the market, then we can have the liberalized mechanism. So the LUMS dual rate system, March 1992. In 92, India didn't want to jump straight into the free market, so they created a split pricing system for rupee called as LUMS. Fine, split was the term, split pricing. So supposingly, let's go with the example also. If you were an exporter and earned the foreign money, you had to split. In the first stage we are talking about, when the RBI just opened the market. So 40% had to be sold to the RBI at low government fixed rate. So the government could buy essential things like oil, fertilizers cheaply. Fine. So when you talk about the 40% of the transaction amount, it had to be sold to the RBI at a lower amount, which is fixed by the government. Remaining 60% you can sell it at a higher market rate, which is determined by what the people were actually willing to pay. Fine. So why you want to sell it to RBI? Because we want to have one fixed mechanism. The government should buy essential things like oil, fertilizers for cheap rates. Right? That was, you can say, a pilot project. Right? Later on, or for that matter today, when we say that the market is free in our country also, this 40-60 split is no more applicable. We have the modified LUMS. The unification of exchange rate of the rupee marks the beginning of the era of market determined rate regime of rupee based on the demand and supply of the forex market. Just like the price of gold, vegetables, you don't see any regulation of the government when it comes to the gold rate, right? It is what the market is doing. It is also an important step in the progress towards the current account convertibility, which was finally achieved in August 94 by accepting the Article 8 of the Articles of Agreement of your IMF. So when we talk about this split system, then unified system after this split, and ultimately having the Articles of Agreement signed with the IMF, we have done what? As a country, we have moved towards the current account convertibility. Fine. So that is how we were able to go towards the current account convertibility, and India indirectly told the world that for daily businesses like importing goods, traveling abroad, sending money for education, you could freely convert the rupees into foreign currency without needing any special government permission. Fine. So yes, this was it for today's class. I hope that you have learned some new dimensions of forex market. And when we talk about the terms which we have learned today, these are the terms starting off with OTC, over the counter. It is what? Just a trading style. Fine. That over the counter you are just making certain purchases and the other party is selling the goods. Then we have LUMS. This is what? A transition, a particular gap which has been filled by the liberalized mechanism, the bridge from fixed rate to the market rate, or for that matter current account convertibility. Then we have the convertibility also, that is your freedom. It has provided the freedom, ability to swap the currency for travel or trade. Also the downward adjustment, more or less the focus is what? Your strategy, how you strategize things, because ultimately if the government is not going with any kind of devaluation of the currency, they won't be able to make the free choice of converting the currency even for the current account transactions. The reason is your good strategy. So making the rupee cheaper to help the exporters and ultimately passing the test of the forex market. Okay. So this was it for the concepts which we have learned today. Basic process which interconnects the financial markets. Right? Financial markets we have seen in unit number 29th. that we talk about what? The credit market, then we have the money market. Also, we will be discussing the interconnectedness in the capital market. So more or less, these are the three major markets when we talk about financial markets. But for interconnectedness, one important, or for that matter, the most important market would be Forex, right? So the fourth one will be your Forex market, where you will find good number of concepts which will directly link to your interconnectedness of markets, right? So the process via which we interconnect various financial markets, how it happens, that is the first topic. Then we will be shifting our focus to the reasons for this interconnectedness. There must be certain reason why we are trying to interconnect various markets into one, right? And this particular integration only we'll be learning in this entire chapter. What are the reasons? And once we understand the reasons, what is the importance of your interconnected market? Why cannot a market sustain in a secluded manner, in a singular fashion? That is also one of the discussion which we'll be doing under the importance of your interconnectedness of financial markets. Then comes the heterogeneity of financial markets. Why we are integrating these markets? Reason being, they are not at all functioning in a singular manner. They are already bifurcated based on region, based on various characteristics portrayed by a simple market, and based on various tensions which are involved via we talk about the financial market. So already we know that they are heterogeneous, they are not homogeneous, they are not integrated. We need to understand that what is the primary motto that we want to interconnect them. So heterogeneity of financial markets, if you understand this topic, then you will appreciate in a much better manner that why we are focusing on the importance of the interconnectedness. Then comes the achievement of market integration in India, because as I have told you earlier also, if you want to understand in a much better manner that how the markets function in the global level, you must start with the regional level, that is our country India. So here also we will be discussing about certain achievements, not all, certain achievements which we have accomplished over a period of time when it comes to the interconnectedness of the market. Then different levels of market integration is also there. Fine, level, you can say regional level is there. Then we have global level, or for that matter, when we talk about the domestic level also within the country, across the globe, and some regions are integrated. That is your regional approach, where we find the special mention of your ACU, Asian Clearing Union. Fine, Asian Clearing Union, a comprehensive arrangement of various central banks wherein we try to integrate the markets based on the region, that is Asia. Then we have benefits and costs of interconnectedness of markets. Again, what are the benefits? More or less an extension of the importance part only. Fine. So benefits, cost of interconnectedness, then interconnectedness of various markets specifically, starting off with interconnectedness of money market. Fine. How the RBI functions, or for that matter, what are the tools via which the RBI will be regulating the money market, and how RBI will be having direct relation with the central bank of, let's suppose, Sri Lanka, Nepal, or for that matter your USA. Then interconnectedness of credit market, how the credit market functions within our country, because the banks are also connected via a simple, you can say, process, that is of your lending. Then we have the interconnectedness of capital market. The capital market is also very much, you can say, interconnected when it comes to the global level. Only based on the interconnectedness we are able to perform much more at a higher level as compared to the non-interconnected markets, because we have multiple options in the capital market when you talk about the global framework. Then the forex market, yes, that is also one of the interconnection which we will be studying. Lastly, the interconnection of your treasury operations, very important point. The treasury operations are the most important ones when it comes to the examination. Fine. So treasury operations we'll be learning in our classes, fine, the paid classes. Here we have elaborate discussion of the treasury operations also, and the most important effect or the phenomena known as the contagion effect. Fine. So when we talk about the interconnectedness, then you must think that it is only about the positives. It is about the positives, but what about the spillover effects? What about those effects which will be impacting not only the area with financial crisis, but the areas, the regions, the bilateral ties with which the country has from various members, like the example of AFC. Fine, we have the Asian financial crisis 1997. The southeastern you can say countries, they were having financial crisis, and the spillover impact was on various regions from where they were interconnected. So this particular effect where the negative impact spreads and it is very much contagious for those countries also is known as contagion effect. So all these terms we will be learning in the entire chapter of your interconnectedness of markets and market dynamism. So good evening, Selva Raj. Very good evening. Okay, so I hope the overview is clear to everyone. Now let's move on to the specifics. Starting off with the process. See, this chapter, unlike your previous chapters in module D, it is much more theoretical. Fine, you will find theory, the discussion is ongoing. So in the examination also, if the question comes, they will be talking only about the statement based questions, from where you will expect the characteristics, the process involved in these markets, the interconnection. So what is the process via which we can say that interconnection has happened over a period of time? So it started off with the development of economy and with the forces of globalization only. Earlier, when every country was having its own part to play within its domestic economy, no type of interconnectedness was there. Once the markets were open for various countries, within various countries, for having tie-ups with other countries, other nations, then only you can say that the process started of interconnection. So it starts off with the development of economy, because once the economy is developed, then only you will be having good relations, good ties with other nations as well. And with the forces of globalization setting in, the different financial markets in India are interconnected with each other and interconnected with the markets in other parts of the world as well. So markets are connected within our country, but along with that, they are also connected with the abroad based markets. Fine, the markets which are present at a foreign level or the global level. Similarly, other countries in the world, they are connected to one another, and ups and downs in one part of the globe can have the resonating effect on the other parts of the globe as well. Like when we talk about the USA, fine, USA is having n number of sanctions on various countries nowadays. India is now an exception, but still some countries are there where this impact is detrimental for their economic progress. So all those countries, if you see their economic growth, it will be hindered for sure. In longer run, you will find that there will be certain hindrance. But whether it will be limited to them only, no. The trading partners of those countries will also have some negative impact, because now the countries which are doing good, they are not at all having the economic growth in the future if the situation remains the same. So whether we talk about the ups, that is the profit making exercise of various countries, or downs, which we talk about the contagious effect or the contagion effect, there you will see that the interconnectedness will have a negative impact also. This has been well seen whenever there was a financial crisis like the Southeast Asian currency crisis of 97 and the global financial crisis on 2008-9, when upheavals in the markets in certain parts of the world sent ripples like earthquakes in other distant parts of the world as well. So when we talk about the ripple effect, it is nothing but the after effects of a particular phenomena, and the particular phenomena which we are talking about here is your Asian financial crisis of 97, which started off with Thailand, spread over various other Southeast Asian economies, or for that matter, the global financial crisis of 2008, which started off with USA, but ultimately various countries from where the people who were residing in USA were impacted. This is also known as coupling of economies, because you are not only having the impact in Asia, not only in Thailand, but the entire Southeast Asian countries, the entire region of that particular part of the globe. So the coupling will happen of the economies, and disturbances, when they spread, once they start spreading, then we call it as contagion effect. Fine. The spreading of negative impact of interconnected markets will be termed as your contagion effect. Like we say na, that this particular move of a country is contagious to its economic growth. It will be detrimental to its economic growth. That is what we are trying to say in the interconnectedness of financial markets as well. Now comes the part where we will be talking about the integration in a much more elaborate manner. So integration of financial markets, it is just a process of unifying the markets, enabling convergence of risk adjusted returns on the assets of similar maturity across the markets. You have a set of assets, fine. Let's suppose in India, you have a set 1 where there are n number of assets, asset 1, 2, 3, 4, fine. These assets are lined up in our market, fine. And you want to trade these assets in the set 1 of, let's suppose, USA, fine. USA, somebody is there and they want to have an integration with the Indian market. So they also must be having certain assets comparable to your asset set, and once you start trading within various countries, among various nations, then we can say that integrated approach has been followed, fine. So interconnectedness will be established once you have the proper set of instruments which are having similar maturity, fine. The assets of similar maturity must be traded. You cannot just say that I want to have the interconnectedness in the derivatives market and you give me certain instruments from the money market. No, makes no sense, right? The process of integration is facilitated by an unimpeded access of participants to various market segments. If you say that we are restricting your movement in a particular financial market, let's suppose capital market, but we are saying that yes, you can move freely or have trade relations with us in case of forex markets. Do you think this is a sustainable model? Answer is no. Why? Because you should be able to understand that interconnectedness does not mean that only one financial market will be having the integration with the other. No, all the financial markets, if they are being integrated with the other country, then we can say that interconnectedness of financial markets is complete via the process of integration. Okay, financial markets all over the world have witnessed growing integration within as well as across the boundaries, and this is what we are looking for, fine. Via this concept, we want to have a particular relationship between various markets across the boundaries, across the nations, spurred by deregulation, the globalization and advances in information technology. So earlier what used to happen, the markets were very much regulated, like we have seen in the previous lecture also, that the Indian government, it had good control over the exchange rate, fine. The exchange rate was not deregulated, it was centralized, and because of that the market was not open at all. Once the decentralization or the deregulation of the rates happened, then only Indian forex market grew. Similarly, when you talk about the economic reforms of 91, where we opened our market for the global players, for the global market, the globalization process happened, and we can for sure say that integration has been succeeded. Lastly, when we talk about the information technology, so not only via the markets but also thanks to the enablers, and IT is one of the enabler of this integration. If there was no information technology, you won't be able to connect, you won't be able to communicate with the partner nations in a better manner. So all these things are very, very important when we talk about the process involved in the integration or interconnectedness of financial markets. Fine. So you must have similar maturity assets, you must be having a direct relationship between the participants. Fine. The access to the market segments should not be restricted. Also, the deregulation process, the globalization process, and IT will ultimately give you the final answer when it comes to the interconnectedness. Now comes the next topic, that is reasons for your interconnectedness. Why do you want to be interconnected? You can have your own country being run on your own terms, right? Then why are you going for this particular process of interconnectedness? Answer is very, very simple, because we do not want to have a limited success in every domain. Limited success will come when you only have a restricted view about a particular financial market. But here in the interconnectedness or the integration of financial market, what is the essence? We want to have a broader aspect of your growth. We want that the capital must be accessible to you, and if you are in need, the countries will give you capital, they will give you money when you are closed or an open economy, when you are trying to become an open economy. So the implications of integration are as under: capital has become more mobile across national boundaries as nations are increasingly relying on the savings of other nations to supplement the domestic savings. In India also what happens? We have one of the mechanism known as external borrowings. Fine. External borrowings via which we finance our deficit. Fine. The deficit financing happens via the external borrowing. We don't have that capacity as a singular nation, but if we include other nations, if we utilize their savings, then we can definitely go for the overall capital requirement. We can fulfill our capital requirement. Then comes technology developments in electronic payment and communication systems. Now when we talk about the technological development, why it is essential and why it is one of the reasons discussed here? Because ultimately they have reduced the arbitrage opportunities across financial centers, thereby aiding the cross-border mobility of funds. What was arbitrage? Right? Arbitrage simply means that you are buying from a market where the funds are available at a low price. Ultimately you are selling the same funds in a different market but with a huge leap of funds. Fine. You are having good amount of funding from the particular transaction which you have made. Fine. So that is the reason why the interconnectedness must be there. And when we talk about overall, fine, overall how you should have the operating framework in case of money market ongoing, why it is one of the reason. So the changes in operating framework of monetary policy with shift in emphasis from quantitative controls to price based instruments such as short term policy, interest rate, brought about the changes in the term structure of interest rates. So when we talk about the term rates, earlier in our monetary policy, the term rate was fixed for a longer duration of time, and if a term rate or the policy rate is there for a longer term, then the market has a perception about your country that you are not at all willing to change the key measures, the key characteristics of your economy. So yes, that is also one of the reason why now we can have much more interconnectedness, much more integration, because we now have a short term policy of your interest rate. Almost within 2 to 3 months you will find new policy being implemented by the RBI. Next is harmonization of prudential regulations. Now, when we say that prudential regulations are being implemented by the RBI within the country, then everybody knows that RBI wants to have strict rules being followed by the banks. But what about the prudential norms across the globe? If RBI is having the same norms and the other Asian economies are also having the same norms, don't you think so that it will become much more easier for the market players to get involved in the overall setup of financial markets, right? So that is also one of the reason why now we see good interconnectedness as compared to the earlier time, because of this harmonization of prudential regulations in line with international best practices enabling the competitive pricing of products has also strengthened the market integration process, right? So market integration process has definitely improved over a period of time, and when we talk about the overall structure, how it can be guided by the particular person. So yes, not only the entities, the business entities, but individuals can also have benefit from the interconnectedness thanks to these four reasons. Next comes the importance. Fine, you know for sure that interconnectedness is now present in your country. So what are the important areas which you must know about this integration? So importance of interconnectedness of financial market, there are various points why it is important to integrate the financial markets. First of all, it serves as a conduit, as a pipeline for authorities to transmit important price signals. Fine, if you have integration within your country, fine, within India and across the globe as well, so it becomes very easy for you to go for a particular case in which you will be trying to simplify the norms, trying to simplify the measures which are involved in the integration of your financial market. So definitely integration will serve as a pipeline for the authorities. They can directly transmit the important price signals. The fluctuations will be directly transmitted to the public. The benefits will be directly transferred to the public. The stability of the market will be directly transferred to the public. Efficient and integrated financial markets constitute an important vehicle for your promoting the domestic savings, investment and consequently the economic growth. Now when you have integration in the market, you must be knowing that you have the access to the market also, and accessibility is now much more higher as compared to the earlier times. And once you have the accessibility, you can make good decisions. You know for sure that yes, this particular decision I can take within a time span of, let's suppose, 20 minutes, 30 minutes, or for that matter 24 hours, and that particular decision will ultimately lead to either the positive returns or the negative ones. Right? If you don't have the integration in the financial market, how you can even take that decision? And supposingly the decision turns out to be a positive one, then what will happen? You will have good returns. Ultimately your savings will increase, and once the savings increase, the investment capacity will also rise, and which will help you to contribute towards the economic growth as well. So that is the direct implication of integration of financial market. It also fosters the necessary condition for country's financial sector to emerge as an international or regional financial center. So we have various powerhouses in our country as well as abroad also, where you will find that one sector which is on boom, or for that matter it is doing really well, is the financial sector. Reason being the integration again. So yes, the necessary condition which is there for your financial sector, which can emerge as the international or regional financial center. So India, why it is being preferred? Because of the cheap labor, right? We have the cheap labor here, and this labor will be very much fruitful for all of those countries who want to have maximum profit. And how they are accessing this kind of labor in our country? Via the integration. It enhances competition, efficiency of intermediaries in their operations, and allocation of resources contributes to the financial stability. Again, when you have the integration, you must be knowing that there will be a competition also. How much you have the access to the market, it is the similar level as compared to some other person who is residing within your area, within your country. So it will ultimately do what? It will ultimately imbibe the feeling of competition, and with competition we have seen that the profit will also rise, ultimately benefiting the economic growth. It leads to innovation, cost effective intermediation, thereby improving the access to financial services for the members of public institutions and companies alike. All these members will be having a positive connotation thanks to the integration of financial markets. It also induces the market discipline and informational efficiency. So you must be knowing that there is a term known as market discipline. In market discipline, it is not only about how much you invest, but how you invest. What is the efficacy of your investment? And you can have it from experience of yourself, or for that matter experience of others. And when you have the integration of financial markets, if your financial markets are already integrated, you can learn from the others' experience as well. Ultimately, you will be having the market discipline with which you will be having a mindset where you do not spend money reckless. Right? The reckless spending will go down, and that reckless spending will help you to save more, again have more money for the investment, and consequently economic growth will happen. It promotes the adoption of modern technology payment system to achieve cost effective financial intermediation services as well. So more or less, when we talk about the interconnection, or for that matter integration of the financial markets, it will ultimately lead to what? The promotion of the modern technology, because based on the modern technology only you are able to have the integration. Now let's move on to the heterogeneity. What is the heterogeneity of financial markets? We are studying this topic of your heterogeneity. Why? Because we want integration, we want interconnectedness of these markets. That is the reason why it all starts with the heterogeneity. Fine. If it was already homogeneous, why would we be talking about the interconnectedness, right? So if the markets were not heterogeneous, or for that matter they were homogeneous, if they were already homogeneous, there would hardly be a case for their requirement in case of integration. Fine. So integration is there. Why? Because they are inherently heterogeneous. That leads us to the question, what causes the heterogeneity in the financial markets? Why the essence of financial markets is heterogeneous in nature? So the answer is very simple, nothing complicated, because as you have seen in the financial markets, we have different types of markets. Forex, we have the capital market, we have money market, the credit market. You cannot just say that 100% overlap is there in all these markets. No. And that is the reason why there is no you can say homogeneity. Fine. There is not at all they are not at all homogeneous, they are heterogeneous in nature. So some market segments, they are national, whereas others are international in nature, depending on where the financial transactions occur among the participants within a country's geographic boundary or across the border. Fine. So it's not like that only from Delhi, or for that matter only from Chennai you can initiate a particular trade, or a particular, you can say Chennai, a particular Delhi, or for that matter a central location is there in Chennai from where you can initiate a trade. No, nothing like that. You can do trade from anywhere you like. Fine. So that makes it much more important, or for that matter relevant, to study the integration. Generally, money and credit market segments involving participation of banks, other financial institutions operating within the country's boundary are national in character. So we have the markets in case of money and credit market, It is what? It is within the country. The banks are where? Within the country only. Fine. Most of the people of your country, they want to access the funds from your bank only. Fine. Nobody is going to, let's suppose, Dubai or for that matter Australia to have the loan. Fine. So you can have credit market within the country. But what about the forex market? People are trying to trade abroad. They want to have the international benefits. But if we are sitting in India, then only credit market is accessible to us, or for that matter money market. The regulations of the RBI, they are applicable to us only. Nobody is talking about the regulations of RBI in Australia. They have their own central bank. Fine. So that makes this particular financial market structure as a heterogeneous one. On the other hand, foreign exchange markets dealing with cross-border transactions, stock markets with cross-listing of securities and participation of foreign institutional investors are international in nature. So you have a set of financial markets which are national, which are domestic only, and the another set which is international in nature, and that makes it much more complicated to understand in a homogeneous manner. That is the reason why we call it as a heterogeneous market across the globe. Then we have some more reasons. Financial markets, they also differ in depth and liquidity. All the markets, credit, money, forex, capital, derivatives, do you think so that they have the same depth and equal level of liquidity of funds? Answer is no. For instance, money market instruments, they are more liquid, much more liquid as compared to the bond market in your capital markets, which are less liquid in nature. Also, the financial markets, they differ in the terms of economic nature of your instruments. Various instruments are involved in different types of financial markets. For instance, distinction can be made between the saving, investment, credit and derivative instruments. You don't see that the derivatives have the exactly same instrument when we compare it with the credit market. The credit market instruments are totally different when we compare it with the derivatives market. Financial markets, they are differentiated in the terms of risk profile also. We say that the government securities, or for that matter treasury bills, the sovereign bonds, they are having lowest risk as compared to the equities. They are highly risky. So the risk profile of instruments such as government bonds, which do not involve default, credit risk, corporate bonds, which are relatively riskier in nature. So we have that distinction also. Integration of market segment thus reflects an investor's attitude towards risk and the trade-off between risk and return on a particular asset. So risk and return, you must have that thing in your mind while studying the financial markets, which financial market you must opt for. And when we say that you have the choice where the risk is high, where the risk is low, automatically we are talking about the heterogeneity only. Market participants in different financial markets could be different. We have banks, non-bank financial institution, mutual funds are there, insurance companies, mortgage institutions, the specialized long-term financial institutions are also there. So the market participants also differ as we move from one market to another market. The banks won't be participating in some markets, or for that matter the NBFCs won't be participating in some type of markets. Capital market, directly you cannot have the relation of NBFCs with the capital market, or for that matter the derivatives market. Not often they are participating. So that also have a repercussion in the form of heterogeneity of your financial markets, and that is the reason why we are studying this chapter also, which is known as interconnectedness of financial markets. Fine. Now let's move on to the next topic, that is the achievement of market integration in India, whether we are able to have the integration or not. So simply stated, if I have to summarize in one line, answer is yes. We are able to integrate our financial market within our country also and across the globe as well. So the important objective of the reforms, the economic reforms 1991-92 has been to integrate the various segments of financial market for bringing about a transformation in the structure of the markets, thereby reducing arbitrage opportunities, achieving the higher level of efficiency in the market operation of your intermediaries, and increasing efficient transmission of monetary policy in the economy. Fine. We want to have such a market setup, such a financial market setup, where we are not at all concerned about the ripple effects of other markets. We are not at all concerned about the ripple effects of, let's suppose, Russia-Ukraine war affecting our market, the Israel-Palestine war affecting our market. That is the achievement which we have made over the past 2 or 3 decades. Then comes the arbitrage. What do we mean by this term? Reducing the arbitrage opportunities. Why we want to reduce this arbitrage opportunity? In order to reduce the speculative trading. Fine. The speculations across the financial market, they will ultimately lead to many adverse impacts for a long-term economic growth. And in order to curb them, we have made this particular measure that we don't want to provide any kind of arbitrage opportunities to most of the individuals. But still, in the financial market, you will find FIIs, the foreign institutional investors, they indulge in what? Arbitrage only. So what is arbitrage? As I have already told you, it is a practice of buying an asset in one market and simultaneously selling it in another market at a higher price to pocket a risk-free profit. You don't want to risk, fine. You don't want to risk any single penny, whatever you are holding in any form, in any type of market instrument. For that, you have the arbitrage, buying in a market which is providing you the same instrument in a less price, selling it in a market with a much higher price tag. For example, when we talk about gold coin, so you must be knowing that the coastal areas of our country, since there the trade can happen in an much easier manner, so they have a relatively lower cost of gold, lower cost of making charges as compared to the northern states. And here comes the loophole which can be utilized via the arbitrage process. So you want to have a gold coin, right, from a particular state in our country. So which state you would be targeting if you are following the arbitrage process? You will be following those particular states which are in the southern location. So the gold coin, for example, being sold for 50,000 in southern states, and you know that for sure in Delhi people are buying this same weight of gold coin for a much higher price, let's suppose 52,000. So if you directly buy the coin from Kerala and sell it immediately in Delhi, you will have what? A 2,000 rupees profit, and that is what is known as arbitrage opportunity. Quickly you are making the decision of buying and selling simultaneously, and you make the profit which is risk-free profit. Fine, this one, risk-free profit. Okay, fine. So yes, this was it for today's class. When we talk about the different levels of market integration, how you can integrate the market at domestic level, at global level, and at regional level, we will be learning all these in our paid classes. Fine, paid classes. We have various batches right now.